610. The bear market low point, a couple of dips below the 20th percentile. Right here, we got to 13.36 during that bear market drop. We were already in a bear market at that time. We had our bear market failure here. Actually, it was over here. But we had another failure, and we just kept going down. So that was during that bear market. There's the 1998 long-term capital management dip, a really bad month there, brought the near-term line down. There's 1990. We had a couple of really bad months. It brought the near-term line down to 14. Again, you can see 1982, 1981. We were in a pretty small bear market, but then you have to go all the way back to the 70s, late 70s, to have the near-term line this low, to finish the month this low. So that's not normal, and especially considering we're not really that bearish. I'll show you with the VIX here in a minute. We're just as bearish as we are. We're not so bearish that we're that we're washing out, right? Let's take a look at the weekly, or the Nasdaq 100, the market forecast. We did finish the week, the week with a daily cluster on the market forecast, 9% below, which is in the again that 6 2/3.
I think consumers have money in their pocket, and we're going to have a super holiday season.
I do think we're far enough along that
the Fed put is much lower than it was at any other time since 1987. And that means the market could easily go down 30 to 50% before, Powell comes and says, hey, guess what? There's nothing else we can do but live with intractable and maybe hyperinflation. So here we go.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with money manager Michael Pinto. If you haven't yet watched part 1 of this discussion with Michael, in which he predicts we're headed into the worst investing environment of our lifetimes, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes I discuss with Michael and our advisor partners at New Harbor Financial in this video. And be sure to stick around for the second half of this video, where we go deep into key topics driving the markets this week, including the strengthening US dollar, gold's continued rise, and whether now is the time to start shorting junk bonds. All right, let's get started watching part 2 of our interview with Michael Pinto. Let's make the pivot from, okay, we see this horrible macro situation coming ahead of us. Michael Pinto, what should today's investors be considering based upon the lens that you look through? If they want to avoid that pain that you're saying you want to avoid too.
Listen, so for the past 6 years, I've had this inflation, deflation, and economic cycle model. It has 20 components, 10 for inflation, deflation dynamic, 10 for growth, recession dynamic. That performance is available for anyone who wants to find it. It's third-party tracked. I'll send it to you. You could see how we did in 2020 in the first quarter, how we're doing this year compared to everybody else. Again, that balanced portfolio is getting killed. And the worst part of your balanced portfolio has been bonds. Now, having said that, I have been scaling into both short and long-term duration bonds over the past few weeks in anticipation of finally this inflation print being the highest year over year that we will see for at least some time. And we could talk about what happens in 23 and 24. But we don't want to talk about that now. We're talking about what to own at the current juncture, not what you want to earn years from now. Now, I can make a very cogent argument that we are going to have stagflation like we've never seen before when the Fed and the Treasury sing kumbaya, and there's massive multiple record trillion monetization of universal basic income to pull the housing market out of a nosedive, to pull the stock market out of a nosedive, to pull the credit markets out of a nosedive. That could happen, and that would lead to stagflation, and I wouldn't want to go near a bond. But right now, what I own in the portfolio, which is working very well for us, is I own gold, a record amount of gold and gold-related investments. In other words, physical gold and the miners. I have bond and bond proxies. What's a bond proxy, Mr. Pento? Utilities are a bond proxy. Walmart acts like a bond proxy. We own shorts. We are short the junk bond market. And again, we own both long duration bonds and short duration bonds. And it's that.
Hey, Michael, I'm sorry, when you say long duration and short duration bonds, are you talking a mixture of different types of bonds? Are you talking just US Treasuries themselves?
Only US Treasuries, short duration 1 to 3 years, and long duration. So think 20 years plus out of the yield curve. Now that's a much smaller position than the shorter duration, because I just don't think the Fed can raise rates 9 times this year. So if you look at short duration bonds, they priced in already, this is part of the consumer's pain, they priced in 9 rate hikes in 2022. I believe, my bet is the odds are very high that the Fed never gets near 9 times. As I said at the start of this list of horrors,
Parade of horribles.
Parade of horribles, is that the yield curve has inverted after one lousy, measly 25 basis point rate hike. It normally takes 300 basis points. And after that 300 basis point rate hike occurs, it's only 100 more basis points. So think 4 25 basis point rate hikes before the Fed says, surprise uncle, says, I can't do this anymore. The economy is so weak and the stock market is so weak that I now have to switch. Well, they're going to do 100 basis points by June or July. And there's no way that the Fed is going to stop by then. They're going to stop before they get 9 rate hikes, but 2 more rate hikes, 4 more rate hikes? No.
So sorry to put the pressure on you, right? But yeah, you're saying, okay, Fed's going to be much more aggressive than most folks realize, but they're not going to get all the way to 9 this year. So where do you kind of peg it? Where do you think they're eject?
Okay, so let's go through the litany since you asked me. So it took a 6.25% Fed funds rate in 2000 to break the economy. It took a 5.25% rate hike to break the economy in 2006, 2007. It took a 2.5% Fed funds rate to break the economy and the credit markets. Adam, here, I'll do my impression of Joe Biden. In 2018, this was long before, forgive me for that impression. In 2018, the point here is that it was long before COVID. The Fed reached their ceiling in 2018. They said, oh boy, let's raise rates from 2.5% to 3.25%. Remember, I don't know if you remember this, but that was the threat from Jerome Powell. We're going above R star. It's actually comical.
Yeah, and never got
Bank knows what the neutral level of Fed funds rate is. So R star 50 points higher. Stock market falls apart in the fall of 2018. Russell drops 25%, 30%. So they say, oh, no more rate hikes, but we'll continue watching the paint dry on QT. Well, again, by 2019, the fall of 2019, that had us. In fact, they stopped QT in July of 2019 because that wasn't working out too well for them either. This current QT is going to be 2 times greater than the previous peak of quantitative tightening. 2-fold. Okay. So they're not going to get very far. That's your question, I believe, if I remember correctly. They are not going to get very far. I believe that maybe 1.5% is my best guess.
Okay, so about a 1.5% in the Fed's fund rate. That's what you kind of think.
So the question should arise, Mr. Pento, why is it that the threshold of the Fed funds rate continues to decrease to the point where it would break the economy? the apogee of debt, total non-financial debt in the year 2007, total non-financial debt was $33.5 trillion, about 220% of GDP. That has now skyrocketed to over $63 trillion, 270% of GDP. And if you look at total debt, including bank debt, it's over $80 trillion. So the simple reason why the threshold where things falter keeps on reducing is because the amount of debt in the system continues to increase exponentially. That is the reason why.
All right. So, I mean, in many ways, we could characterize where we are in the macro story here, kind of worldwide for the global economy, is too much debt, right? And that is sort of summarizing the trend of many decades and bad policy and whatnot. And we're at the point where that debt may no longer be serviceable given the rollover into growth evaporating and us falling potentially into global recession here. And so reason why I'm harping on this is there are a number of people, including an interview I just did recently with Simon Hunt, where he basically said, I think we're at the point where that can that has been kicked decade after decade after decade by the central planners is not going to be able to be kicked any further down the road. And this is going to be the moment where the bad debts are going to have to clear the system. And it's going to be really painful for a lot of people. The good news is that maybe by having some of that, a lot of that bad debt clear out, a lot of that malinvestment clear out, it provides us the opportunity to start from a more sane baseline going forward. You don't have to share that opinion, but if we're going from this current inflationary, worry we have right now, where market, asset prices are still kind of, nearish all-time highs, do you see us going into, a bad bear market, but then kind of, cycling out of that again? Or do you see this as being, you used the term earlier, the worst bear market in our lifetimes. Do you sort of see this as sort of the definitive clearing event of all that bad malinvestment that's been building up over the decades?
My visceral response to that is looking back at how important asset prices are to an economy. So if you look back in the year 2000, the total market cap of equities as a percentage of the underlying economy was about 145, 143% to be exact. So fast forward to 2007, it was only a little bit over 100% of GDP. In my last interview in January, it shot up to 210% of GDP. And now it's only down to about 185, 186% of GDP. Still about 40 percentage points higher than it was in the great NASDAQ bubble in the year 2000. So the question I asked myself, can you actually have this grand debt jubilee or reconciliation of asset prices without a depression like we've never seen before? And the answer is probably, most likely, almost most definitely no. And then what is the risk tolerance for those in charge to allow that healing process to consummate? And I think that tolerance is very low. So I would agree with that person that that's the gravitational forces of deflation, that cathartic rebalancing that needs to take place will start to happen, but is it allowed to do its job? I would say probably, given that the asset value as representative of the economy has risen to such a high level, it can't do it in isolation. Like in 1987, when we had that 23% down day, it was barely a hiccup in the economy, because Greenspan reliquefied the system. Inflation wasn't a salient issue back then. and total market cap of GDP wasn't anywhere near where it is today.
Right.
I think it was like below 50% back then. So you cannot have a grand, cathartic, necessary reconciliation of asset prices without engendering a depression. And I don't think that's a politically tenable position for anybody in power.
Okay. I'm just going to restate what you said. Correct me if I'm wrong, but you say, look, that's what the forces of reality want, right? They want
Demand.
that they want that clearing event. They if left alone, the markets would just deflate to get rid of all that bad debt, and it would lead to an economic depression because of the scale of all that bad debt that's out there. You're saying that the Fed is trying to engineer getting some air out of the balloon, but it does not want the system to just crash to the ground. So at some point, and you said, and maybe it's around a 1.5% Fed funds rate, it's going to step in. And if the deflationary forces, really start raging, it's going to do everything it can, kitchen sink, et cetera, to try to prevent that from happening. I think that does open an interesting question about, can they be successful this time around? I don't necessarily want to rat hole into that because we get really highly speculative at that point. But obviously, if you have a strong opinion, chime in on that. But let me get back to this question about sort of tactical things for real investors to be thinking about here. You were very generous in just sharing the position of your current portfolio. Quick reminder, that's short-term and long-term duration bonds. It's bond proxies like utilities, companies like Walmart. You're holding, for you, record amounts of gold and precious metal mining companies, and you're short the junk market. Now, when we've talked previously, you've said, hey, at some point in a big deflationary downdraft in the market, you want to shift like totally into the four horsemen.
Yes.
And I'm saying yes, so it sounds like you still think that way. Can you remind people what those four horsemen are, and can you say what are the indicators you're going to look at to say, okay, now is the time for me, Michael Pinto, to get into these four horsemen in total?
Okay, so the four horsemen are cash, short duration bonds, the U.S. dollar, and actual shorts in the stock market. I am actually short the stock market 10% right now. When would I sell everything else, or most everything else? And what would be my cue to do that? Well, if you remember, why would I do that? Why wouldn't I sell? Why would I not hold GDX and some miners that I own? Why would I not hold that through the liquidity crisis? Well, because they don't work. I mean, gold miners are stocks, and everything goes to a correlation of 1 when the liquidity crisis hits. Everybody wants one thing. They want cash. They want dollars. The globe wants dollars. It's not just the shadow banking system and the banking system. Everybody wants dollars, and they sell what they can. And gold is one of those things, and certainly the miners are one of those things. So I expect that to happen again. It'll be a truncated collapse. So if you're not an actively managed portfolio like I am, I'm here every day going to work. I go to work every day and look at the credit markets. The most salient indicator that I will use is my model, the high frequency components of that model. And the top of the list of the high frequency components are the credit markets. And when I see them start to tighten, I'm not going to give away my model completely here, but when I will absolutely know when the credit markets are about to freeze over. And when that happens, when that spread between junk bonds and treasuries begins to blow out, according to what my model has dictated, the point of panic should be in the stock market, that is when I will head into those four horsemen of the apocalypse, which, by the way, this is where we started this interview. You don't have to be a victim of the worst bear market in history. It can actually be very beneficial for your portfolio if you know when to own those four horsemen. What to own and when is absolutely crucial. And I've been doing this 32 years. I've been in this business for 32 years as a licensed professional. And it took me decades to perfect this model, and it didn't really officially launched until 2016. But if you have an actively managed and you have some great people that you work with. It doesn't have to be Penta portfolio strategies.
Yeah.
I don't know if he has a model, an actual algorithm that I have, but I have this algorithm, and it worked very well in 2020 in the first quarter. It worked very well this year. It should work, hopefully, God willing, very well in the next collapse, where you can actually protect and potentially profit. Can't guarantee it because it's illegal. And no one would do that if it has any, scruples. But you have the potential to protect and actually profit from this great reconciliation of asset prices as long as the Fed lets it happen. And again, because of the new function of inflation, which is now way above, it's over 4 times their target level, the Fed put is much lower than it was at any other time since 1987. And that means the market could easily go down 30 to 50% before, Powell comes and says, hey, guess what? There's nothing else we can do but live with intractable and maybe hyperinflation. So here we go. I don't know why that person, I don't know why he ever went for another term. He's a billionaire. He had some success the way they define it as a.
I was going to ask you that. Like, why? This guy knew probably better than almost anybody going in what he was going to be facing when he went up for renomination. And I don't know why anybody would sign up for such a, from my perspective, an unwinnable position.
I think I can answer that. I think I can answer that. When you have the hubris to believe that you know more than the market, when you have the arrogance to believe that you know the exact cost of money at all times, then you are arrogant enough to believe that you could hold that job, even faced with the most daunting task of landing a jet on an aircraft carrier the size of my driveway. And I have a decent sized driveway, by the way.
I get it, but it's not like he hadn't been spanked before. I mean, it just didn't sink in, I guess, right?
Paint dry, transitory, and maybe he'll resign and say, you know what, take it. Whoever's next, take it. Whoever's the vice chair at the time, take the position, because this is impossible. It's a no-win situation. He actually was at the helm of the Fed when they lost complete credibility. He'll have that disgrace of knowing he had the highest rate of inflation ever in reality. But even the way the Fed measures it and the Labor Department, BLS, Bureau of Labor Statistics, measures it, it's a division of Labor Department, highest inflation we've had in 40 years. That's his dubious legacy. And now he's going to have the legacy of destroying the stock market once again.
All right. So we're swinging punches here at Jerome Powell, and we think he deserves it. Maybe he doesn't. Who knows? But okay, Michael. So let's say Michael Pinto is right. Market goes down another 30 to 50% from here. If I've been listening correctly to you, there is a point in that process where Powell is looking maybe not so much at the stock market pain, but looking at the wheels coming off the economy and saying, all right, I'm getting nervous that this whole thing could be going down now. And so I need to pivot. I'm going to go back to QE. I think you think it's going to be pretty prodigious in scope. Tell us what you think that would look like. And if you can put your investor hat on and say, okay, when we switch to that regime, if I'm going to get out of the 4 horsemen, where am I going to go into?
Yeah. Well, you have to have a completely different regime from deflation and recession depression, which is sector 1 of my investment spectrum. I have 5 spectrums of inflation and growth. That's sector 1. That would be deflation and depression. Well, you can't stay in deflation if the Fed is going to monetize, with the help of the Treasury at the time, good buddy Janet Yellen, multiple $1 trillion of universal basic income. Hey, Adam, I told you, and I told the Fed and anyone else who would listen to me, all the way back to the Kudlow show in 2006. I said, if you want inflation, this is what you have to do. You give people money directly, you circumnavigate the banking system.
Right.
So,
and just for folks listening, because that is the fastest way to spike monetary velocity, to get that money flowing into the economy. You know, a lot of what's been going on with the QT, with the QE, with the 200 billion a month and whatnot, a lot of that kind of built up in the banking system and didn't necessarily find its way out into the real economy. It certainly went into asset prices to a certain extent, but it didn't directly get into the economy. Whereas Michael was saying earlier, you give people direct checks, well, they go out and spend it. It immediately goes out there, immediately prices go up. So sorry, Michael, I just wanted to clarify that.
That's okay. You can interrupt me anytime you want. I do it myself sometimes, as you know. So Jim Rickards, I think, has it partially correct. I mean, Jim Rickards had his thesis is that QE isn't inflationary because you don't get that velocity. Well, he's partially right. QE is not inflationary when it comes to consumer price inflation. It's highly inflationary when it comes to asset prices. Because during QE, you create electronically, the Federal Reserve creates money out of thin air, and they buy an asset from a bank, one of the primary dealers. Well, if the primary dealers know that you're going to come and buy bonds, and in this last iteration of QE, they did, you know, municipal bonds and junk bonds and corporate bonds and treasuries, of course, as they always do. If a bank knows that, they're going to take that money and they're not going to loan it to Wall Street. They're going to go out and buy more bonds. Wouldn't that make sense? They'll front run the Fed. So you have massive inflation in bonds. Prices go way up. The yields go way down. You got inflation in corporate bonds and junk bonds. You got inflation in the stock market. It's very inflationary for Wall Street. But the Fed, I don't know, maybe they knew it the whole time. They play dumb very easily. Very easily, they play ignorant. They claim ignorance. But if you want to get inflation going, you do exactly what we did in COVID. You don't give QE just to banks. You directly monetize Treasury debt. You say, okay, Treasury, you send the checks out and I will buy bonds using the banks as a conduit. And the money goes directly to people, directly to businesses. And I think that's going to happen again. But the point, again, when we reach that epiphany, when we being the FOMC, when the government reaches that epiphany, they will be at least tacitly admitting, but I'll make a big I will promulgate this as loud as I can. They will tacitly admit to Wall Street, who will get it, the people who really understand macroeconomics will get the point. They cannot ever reduce their balance sheet. They cannot support the value of the dollar. They cannot provide consumers with stable prices. They cannot protect the purchasing power of those same individuals. And they cannot defend the purchasing power of sovereign debt. It's going to be known out there. I'll make a big stink of it. And if you're going to sit there with the four horsemen, when stagflation, like we've never seen before, is going to be the predominant macroeconomic condition, which is sector 5 of my spectrum, you're going to be in big trouble. So you have to be an active manager. You can't sit in a 60-40 portfolio because you're down double digits or a lot more, depending if you're Cathie Wood and if you've been massively long duration in the sovereign bond market. You're down 16% this year. If you're long Cathie Wood, I'm not going to quote her returns, but I think everybody knows it's not spectacular. What don't you want to own in this kind of market right now? High beta names. So you have sectors and style factors you need to avoid. People who own companies that have no earnings and all of it is in the future, and their cost of capital, these zombie companies that have to raise debt just to pay interest on existing debt, they're in a lot of hurt. And before we end up this interview, I just want to say one thing about that monetary cliff. You know, if you look at the real Fed funds rate, because of that $200 billion average QE from March of 2020 to March of 2020, March of 2020 to March of 2022, the real Fed funds rate was profoundly negative. We can debate about where it was, but it's going from a negative, whatever, 1%, 2%, you could pick it, all the way up to 1 to 1.5%. That's a big move. When you add quantitative tightening to that, which I think QT is even more deflationary than raising the Fed funds rate, you're having the most hawkish Fed in history, other than possibly Paul Volcker, and we're going to have that's going to lead to the worst bear market that we've seen in our lifetime. And the Fed, China, Russia, nobody is going to be able to bail you out. Europe, neither. I mentioned Europe. They're not going to do it.
All right. Well, look, you've been incredibly generous in sharing your particular strategy for protecting against that process that you just laid out there, or protecting as best we can. I hate to wrap this up, Michael. We've gone about an hour and 20 minutes in the whole time here. I'd love to add 2 or 3 more hours on here. I'm sure a lot of our viewers would too, but I've got to be respectful of your time. So I guess as we wrap things up here, 2 questions for you. First, any parting bits of counsel to just the average prudent investor who's just looking to make it through, this future you're laying out for us here intact that you haven't already talked about?
Yeah, I mean, if you don't, I mean, my minimum is $100,000. If you don't have $100,000, I can't take you as a client. It's in my ADV. I can't. Go to cash. People say, well, how could you recommend going to cash when you just said inflation is 8.5%? Well, that's illogical to me. If you have an investment account and you're determining, should I lose my principal by 30% and then start to subtract inflation? Or should I just subtract inflation and keep my principal intact? What would your answer be? What would be the logical conclusion? Go to cash. And going to cash for some time is not going to destroy your life. And it might be the smart thing to do in the next couple of years, or at least the next couple of quarters.
All right, and thank you for saying that. We've talked about hedge on this program a lot recently, both sort of as a smart, simple hedge like you're talking about there, and also the optionality that it gives you that at some point in time, if indeed price is correct by the magnitude you're saying, well, then you can deploy it at much better valuations, right? So Michael, I'm glad you mentioned the fact that you have a registered investment advisory firm. For people that are interested in learning more about you, your work, your firm, where should they go?
So it's pentaport.com. And on that website, you'll see the midweek reality check, one of the navigation buttons. You can sign up for a free 5-week trial. If you like what you hear, for $50 a year, you can become a subscriber. And I'll give you my 36,000 foot interpretation as I do on your program. And if you want to have your money managed by a manager who isn't wedded to anything or any agenda other than making you money, then, and if you have 100,000, and if you're a U.S. citizen, I would gladly take you as a client. And instead of just putting you in some plug and play model based upon what my back office is pushing that day, or some kind of perma baloney that comes out of CNBC or the mainstream financial media of just buy and holding until things come back, because they don't always come back. And can I just give you one more data point before we wrap this up?
For you, yes.
One more data point. I always hear on CNBC, people say inflation is great for stocks. Stocks are a great hedge against inflation. Well, from the nadir of inflation in 1972, all the way till it peaked in 1980, the stock market lost 7% of its value. Inflation is not a good hedge when you have inflation running this hot. So don't believe CNBC, listen to Adam Taggart, put your money in someone like Lance Roberts, who actively manages your money, or I think you have another outfit called New Harbor, doesn't have to be Pento, but get your mind out of the buy and hold 60-40 portfolio as fast as you can, because your time is running out fast.
All right, Michael. Well, look, I'm going to have to leave it there. Thank you so much again for just delivering, the unvarnished truth as best you see it to the average investor here. That's the whole reason why we've created Wealthy On. So it is no surprise to me, and I think that most of our viewers here, Michael, why you're one of the most frequently recommended guests on this program. And I hope we can have you back again many times as the progression plays out here. so that you can keep kind of calling audibles, as the situation on the ground evolves as we move from here. But Michael, just want to say thank you so much. It's always such an honor and a pleasure to get to interview you, buddy. Love to have you back on this program again soon.
Again, the privilege is all mine. I want to wish our audience a happy Passover and a blessed Easter. God bless.
All right, well, now's the time on the program where we bring in Wealthion's endorsed financial advisors to both react to what Michael Pinto just said and talk about what the markets have done since last week. I'm joined as usual by the lead partners from New Harbor Financial, John Lodra and Mike Preston. Guys, thanks so much for joining us. Phenomenal discussion there with Michael. Mike Preston, why don't we start with you? What did you take away from the discussion?
Really enjoyed that with Michael Pinto, Adam. Thank you. Always, we've been a big admirer of his work, his money management track record, and his book and his appearances in the public eye. So it's a pleasure to see him talk today. Michael talks about how he's bearish. He was bearish in the beginning part of this year. He said that's been somewhat delayed with, or maybe it was delayed slightly because of the Russian invasion of Ukraine, but still he's very bearish on the remainder of the year. And he says it's because of a record change in fiscal and monetary policies. Absolutely right. I mean, the government has stopped, or there's been a big change. There was a spending spree of $6 trillion back in 2020, or in the follow-on effect of COVID. And that, when you hand money to people, like he says, to go out and spend and tell them that they really can't get outside and produce, all they can do is spend. Obviously, it's going to be stimulative to the economy, but that's all ended in rolling off. And at the same time, quantitative easing, or the monetary cliff, is approaching. And I guess quantitative easing did get as high as $200 billion a month, like he said, but that's all ending. And the net effect of all of that is $1 trillion of base money supply is going to be shrinking going forward, or rolling off the balance sheet. That's a huge negative. And at a time where valuations are at what many believe is a permanently high plateau, and believe me, we're not at a permanently high plateau. That's a word that I think that was Fisher that might have said that back in the Great Depression time. But valuations are far beyond anything that we've ever seen before, and have stayed there for a very, very long time. So he's bearish, and we're bearish, and we're very concerned about valuations in this market, particularly at a time where we're starting to see inflation. Everyone's talking about inflation. The official number was somewhere around 8%. It's probably higher than that, a lot of people believe. And as Michael points out, there's some political pressure now to get inflation down, or to break the back of inflation. Michael speculates that it's the constituents that are going to vote in November that are putting pressure on their elected leaders, and so on and so forth, so that our president is probably putting pressure on Jay Powell to get inflation under control, and he probably takes that into consideration. He probably takes that very seriously. So the upshot of all of that is the Fed put, or the price in which the price of the market in which the Fed will come in and reverse course this time, like they did in 2018, is probably much lower than most people believe, 30 to 50% below, Michael Pinto says. And we would have to agree. Frankly, we think there's much more downside in this market than even that. So the message remains the same: to be careful, to reduce risk and or hedge risk. There's a lot of different ways to do that. So overall, it was a great talk.
All right. Yeah, as he was talking, I could hear you guys making mental notes, because I think it's simpatico with a lot of the way you guys think. John, I'll let you chime onto that with whatever you like, but a question. So we talk about the turning off of those stimulus spigots, and since the coronavirus hit, it was 6 trillion in fiscal stimulus, about 4 trillion in monetary stimulus. That's 10 plus trillion. That's now stopped, right? And Congress isn't passing new fiscal stimulus right now. It's gridlocked there, and the Fed has said, hey, we're actually not even just not releasing stimulus, we're now tightening. We're going to start draining the pool. You add to that the huge inflation that we have. We just found out that the latest numbers for March were 8.5% inflation, over a 40-year high. That obviously eats into profit margins. It crimps consumer spending. It eats into profit margins of these companies. there's just sort of, I use that term parade of horribles here, and yet the S&P is only down 7% this year. And it kind of seems like it hasn't gotten the memo, that the gravy train has left the station and isn't coming back. So my question for you is, are we sort of in this Wile E. Coyote moment where the market has gone off the cliff, but it hasn't quite realized yet that fact, and the pull of gravity just hasn't quite set in, but it's obviously going to. Is that a good analogy to where we are right now in the markets in your eye?
Yeah, Adam, I don't have much to add to what Mike just said. I thought it was a really good synopsis. But yeah, I think that Wile E. Coyote moment is a very apt description because, look, even going into the COVID pandemic, markets were already crazily overvalued by any reliable historic metric going back to, nearly 100 years ago. So what has happened since then, fueled by the kind of stimulus and the fiscal and monetary interventions that we've seen in the wake of COVID, has brought things to a whole nother level of silly. So to think that a 7% retreat or thereabouts from all-time highs, extreme highs in valuations, is pricing in anywhere close to likely resetting of prices as a result of a regime change in monetary policy, it would be very, very illogical to make that assumption. So yeah, the image of a midair floating over a cliff is very apt. I really like that Michael spoke of the difference between what likely is going to be the pace of quantitative tightening in this these next upcoming months to really wrestle with inflation, and comparing that to, say, the 2017, 2018 period there. The pace at which, in 3 months, we're likely going to see a pace of tightening to the tune of, 95 billion, a month, which is, a trillion annualized. That's some big reversal of the pace of what's been done, and certainly puts in what was done in the 17-18 timeframe pales in comparison to that pace. So this is a real shock that the system has not seen anytime, literally, since the housing crisis, and these emergency measures have were unleashed to begin with. So yeah, I think the market's not even close to pricing all that in.
All right. So of course the big question is, all right, well, what do we do about all this, right? And Michael shared his existing portfolio allocation with us, and then he and I talked about, okay, and when do you go to the four horsemen, right? Like when the real storm hits and you're just trying not to lose capital, where do you go? And what I took from Michael was, he said, we're not quite at that stage yet where the kind of house of cards comes tumbling, but we're going to go through disinflation beforehand. And his portfolio for disinflation was short and long-term duration bonds, and mostly talking about treasuries here. He's got a record amount of gold and exposure to the precious metal miners, which I'm sure was music to your guys' ears, because that, I think, is your largest long position in your fund, if I'm not mistaken. He says in addition to those bonds, he has some bond proxies like utilities and Walmart. And then he is beginning to start a short component to his portfolio. Sounds like right now he's starting with shorting the junk bond market. So Mike, why don't we start with you? What's your guys' reaction to an allocation like that right now?
We agree with a lot of it. I mean, a lot of it makes sense. The short and long duration bonds, I think that echoes our thinking in quite a large way, in that we hold a lot of cash. And frankly, we just replaced a T-bill yesterday, Treasury bill. And this was a 4-month Treasury bill, I think. And it yielded 0.75% annualized, 0.74% maybe, to be exact, which unheard of. Not long ago, even last year, we were having trouble just getting the same money back that we invested. That's a 0% return. Many Treasury bills were trading at negative yields. So it's been a huge change in the short end of the curve. The Treasury curve inverted briefly, I think it was last week or the week before. It has since kind of corrected and uninverted. But the short side of things, I'm pointing out, just for example, is that we're up to about 0.75% for 4-month paper, high quality paper. And it's easy to get above 1% to go out just a little bit further. In fact, 2-year Treasury notes are trading at around 2.5% or so. And that's another position that we put into our cash section of our portfolio. So yeah, the short end of the curve is very attractive. There's not a lot of extra juice, in our opinion, to try to buy a corporates or high yield bonds when you can get high quality treasuries on the short end close to a point to above 2 points and not even have to go beyond 2 years. That's very attractive. And that's where the vast majority of our cash holdings are right now. At the same time, we added long-term treasury bonds. We added 20+ year bonds as well a couple of weeks ago. We hedged it. I'm glad we did because we were a little bit early. We hedged it with a short call, but we would like to hold that position and maybe even add to it a little bit if we get further weakness, because we think at some point in here, long-term treasuries are going to bounce. And the inverse of that, yields are short-term overdone. You know, they recently went through 250, I think, 2.50 on the 10-year, went even higher than that. I'm just looking at where they closed today. They closed at about 270. They got as high as 280, it looks like, recently. So yeah, we think they might have overshot a little bit to the upside, which is why we're building a position in long-term bonds with a hedge, as I pointed out. He also mentions physical gold and miners. Yeah, that was music to our ears. We say it almost every week here. We love gold. We think it's likely to go to 2,500 over the next year. That would mean miners using GDX as a proxy would be maybe mid 50s. It closed above, GDX closed above 40 today, almost 41. So it frankly doesn't look like that move is done yet. And all of this is happening while the dollar's getting stronger. You know, the dollar's getting stronger, and it went through, the dollar index went through 100 yesterday, closed just below it today. He also mentions bond proxies and short the junk bond market. I don't think we have much of an opinion on short bond proxies. I think he mentioned Walmart and utilities. Utilities have been doing very well, you know, and that's even with interest rates going up. But we're a little cautious on them, and that's not an area that we're in. I'm not saying it's wrong. It's just not something that we're focused on right now. And lastly, shorts, shorting the junk bond market probably should work, honestly. From a mathematical perspective, it absolutely should work, as should shorting the broad stock market, the S&P. But it's incredibly hard to do so. And we're not short any of those things, although, again, mathematically, I think it probably makes sense. And I admire Michael for finding a way to put that in the portfolio that makes sense for him and his clients. But it's not something that we've done yet. Our approach has been to hold high quality cash and then deploy it later. But there's a high degree of alignment with what he mentioned and what he's doing and what we're doing.
Great. And John, I'm coming to you to let you add any color to that. But a couple of things that Mike Preston here just mentioned. One, that you guys are holding a fair amount of cash right now, which I think Michael Penta would say, hey, that's probably a wise move leading up to, the 4 horsemen period here. But as Mike Preston just said, the dollar index is extremely close to 100 now. It's had a strong rise since the beginning of the year, gone up from about 96 to now just about 100. And it hasn't been at the 100 level for a long time. It kind of briefly hit it back in 2017, I think March of 2017. And then you got to go all the way back to February 2003 before you see the index back at that level. So I'd love for you to comment on just sort of what the significance of this strength in the dollar might be. Well, let's do that. And then I want to ask you a question about junk bonds, but why don't we start with the dollar commentary?
Yeah, those stats you just talked about there, Adam, are right. If you look at, and you can look at dollar strength in many different ways. One is the dollar index, which is a basket of, the index of the US dollar relative to a global basket of currencies. That is right around the 100 mark, right, on the index. And it's touched that point and maybe, poked above it, handful of times, three-ish, 4 times over the last, 4 or 5 years. But yeah, then you got to go back all the way to 2002, 2003 to see a similar period. And again, the really interesting thing here about that is how strong commodities and things like precious metals have been. Typically, those often have an inverse relationship when the dollar is strong, sometimes the commodity space is weaker, relatively speaking, and vice versa. So that's a really interesting divergence, and I think it speaks to kind of the U.S. dollar still is the kind of reserve currency of the world, and it's a flight to safety kind of thing, and liquidity preferences of scared folks. I know you've had gentleman from Santiago Capital talk about the dollar milkshake theory on your
Brent
program.
Johnson, yeah.
Yeah. So yeah, Brett's talked about that a lot in your program. So these are all things that are very complex in a chess game of global economies and geopolitics. But it's a notable thing that there's this divergence between a very, very strong commodities space, including precious metals and the dollar index.
All right, great. And for folks that aren't familiar with what the dollar milkshake theory is, go watch that interview that we did with Brent Johnson that John just referenced. I'll put up a link to it right here. It's a very important concept, especially as trouble begins to hit the global financial markets, because it basically predicts why the US dollar may strengthen a lot more than many people expect right now. And there's some pretty good mathematical reasons for that. So John, you mentioned that commodities have been surprisingly strong, coincident with the dollar strength, and that's surprising, as you mentioned, because they have a general inverse relationship. But in uncertain and times of transition, you can have a lot of long-standing relationships that are more correlated versus causal begin to break. And the danger for investors is if you're just kind of going with the old rule of thumb, it may not apply anymore going forward. So you might be kind of, making your decisions based upon those old saws, that old sort of, conventional wisdom. It might be working against you because it may not apply in the new world. And Charles Hugh Smith, who you guys have seen me interact with many times over the years, he's written several pieces over the years of calling for instances where gold and the dollar will strengthen together, because there really is no reason that they can't. People think of them as inversely related, kind of a seesaw relationship, but it's really doesn't have to be that way at all. And certainly in times of uncertainty, people are looking for safe haven. And obviously, for a lot of the reasons we just mentioned about the dollar milkshake theory and others, the US dollar will strengthen in that period, but also capital will flow into precious metals markets and whatnot too. And we're beginning to see that right now, right? And interestingly, as the dollar has increased strongly this week versus other fiat currencies, it's actually fallen versus gold because gold has appreciated in dollars this week. I want to end on gold, guys, but real quickly, just back to junk bonds for a second. I personally, I think that there's some good opportunity there where, mathematically, as yields go up, bond prices have to come down, right? That is a mathematical relationship, right? And with the Fed coming out and saying, look, we're super serious, right? We are going to go and we're going to increase the cost of capital. We're going to do at least 6+ more rate hikes, left this year. It's a pretty easy bet at this time that until at such point in time the Fed changes its mind and pivots, the cost of capital is going to go up and yields are going to have to go up to compensate for that. So bond prices should come down, and high yield bonds, or otherwise known as junk bonds, well, those are the most vulnerable to this trend, right? Those are the riskiest companies, the ones with the least amount of profitability, the highest potential for default. So they should be the canary in the coal mine. They should be the ones falling first and falling farthest. And they moved somewhat since the start of this year downwards, but they haven't really moved all that much. So where I'm going with this, and Mike, maybe I'll go back to you first, and John, feel free to chime in. Is this becoming more of an attractive play in your guys' eyes? I know, Mike, you said you haven't taken that step yet, but is this a tactic that you think, may be worthy of some of the investors watching the show to at least consider?
I think it could be worth considering, and I assume that you're talking about shorting them, like Michael talked about there, and not buying them.
Absolutely. Sorry
Yeah.
if I weren't clear on that. I was talking about shorting junk bonds. Yes.
Yeah. That's what I thought you meant,
expecting them to fall in price. So
you could just take a look at one of the large ETFs. If you want to take a look at the whole index, you can take a look at JNK or HYG. Just, put that into a chart package and take a look. I just happen to be looking at JNK right now. It's down around 7%. Lo and behold, it's down around 7% year to date, very similar to the S&P. High yield or junk bonds trade very much like stocks because they are totally beholden to the cost of capital, and they're closer to default than any of the rest of the market. So yeah, I certainly wouldn't be buying them here, particularly with their spread or the spread above the risk-free rate being very near all-time lows. You're not getting a lot of juice or extra oomph for the risk that you're taking, and yet we still see prospects from that we talked to here quite a few times having junk bond funds in their portfolio because it's very popular to have those in an asset allocation type program. So if you have junk bond exposure through mutual funds in a passively allocated portfolio, the first thing you could do is sell that fund. You know, you don't even have to go short it. You could simply just start by selling it. But yes, I do think that there would be opportunities to short this market. I would warn that I would do it only if you were very sophisticated and able to take the risk. The problem with shorting an asset like that is that when you short an asset, you have to borrow it and then sell it. So you borrow it, sell it, and replace it later. And while you're short that asset, you also have to pay the dividend, or you owe the dividend every time it pays. And the current dividend is almost 5%. It looks like 4.75% on that ETF right now. So you're paying out minus 4.75% income while you're borrowing it, while you know, at the same time you're shorted. And then of course you have to be right about the direction. With mathematically, I think that it makes sense, but this market is anything but predictable. And it wouldn't surprise me if the equity markets did have one more melt up, like your frequent guest, David Hunter, you know, has often said. And if that happens, junk bonds will also have one more melt up. So that's a long answer. I think ultimately the right direction is down. But it's pretty hard to do. It's pretty hard to do.
All right, good answer. Those are good caveats. I'm glad you brought them up. You're underscoring the importance of why we recommend folks work with experienced advisors if they haven't done this a lot themselves. David Hunter, by the way, we'll be interviewing him next week, so we'll have a chance to ask him directly his thoughts about this. All right, so last topic, guys, just gold. We talk about it a lot. As I mentioned earlier, it had a good week. The miners have done particularly well, though. They have gone from about 38 or so at the beginning of the week. I'm talking about the GDX ETF here. It's now above 40. I think it's about $40.70. David Hunter, to bring him up again, you know, he's been mentioning for months that his target's 50 on it. Mike Preston, I think I've heard you use that target as well. Are we just kind of on track here in terms of things going to plan according to your guys' expectations? John, I'll let you answer this, then we'll wrap it up.
Yeah, I think we are, Adam. We think we are, and I think actually David Hunter's forecast is 60 on GDX, if I'm not mistaken. But you know,
if it is, he's raised it then, but he sure could have.
I may be wrong there, but all to say is that there's likely significant upside. You know, but I want to call out something that you know, Michael Pentel just talked about. You know, and this is something we're very cognizant about, as structurally sound and bullish as we are about the gold mining space and precious metals still, even with their move higher. You know, in a real panic risk off scenario, everything gets sold. And you know, to your point, Adam, about not just taking for granted the, you know, historical relationships. You know, in theory, you know, precious metals move inversely with the stock market and this and that. But in a real risk off scenario, and we saw it, you know, for example, in March of 2020, you know, everything gets sold, even the things that deserve to be held. So we could see a very big move down just in sympathy in things like precious metal mining stocks, because they're stocks, and you know, folks got to sell things to free up cash for margin calls and all these things. And that's why we, you know, as bullish as we are, we have been fairly consistent hedging these positions. With hedges, we use options quite prolifically to build in hedges, and we'll probably continue to do so. And you know, at some point we'll probably be trimming back our exposure there, not necessarily all the way, but trimming back some of the gains we've gotten, all to you know, manage position sizes and things like that. Yeah, there's no guarantee of path higher ahead, but there's certainly a lot of factors that could support that.
All right. Well, good. All good to underscore. I want to point out that, we've been talking about miners a lot in this program. We were talking about them, last year at times when they were down in the 20s. And now we're here up in the 40s, which is just sort of I want to give you guys a little bit of a victory lap for having been a champion of this space. And I do appreciate the reminder there, John, about the importance of hedges and folks. Yeah, as we get to that period that Michael Pinto was talking about, where you need to be in the four horsemen because kind of everything's going to hell in a handbasket together. That's where hedges really have their true moment in the sun, where what they do is they provide insurance for your portfolio, and they kind of act like circuit breakers, right? Like if we get into a market meltdown scenario, like we did in the spring of early 2020, right, when the pandemic hit, the market basically lost what, 35% or so in a matter of like 2.5 weeks. There were days when the market was down 10%, and most investors were just caught flat-footed by that, and they froze like deer in the headlights, and they lost a lot of money in a very short period of time. What the hedges do is the hedges are almost like automatic circuit breakers that get you out of your positions, at some predetermined level, so that you're not riding that elevator all the way down, right? That you're preserving a lot of what you had gained along the way. It's done right. I say this every week, so I won't go deep on it now, but that's a huge reason why we recommend people work, especially during a time of such great uncertainty like right now, with an experienced professional financial advisor who gets all the risks that we talked about with Michael Pinto, but also understands the mechanics of the tools for risk management that we're talking about right here. If you want to learn more about that, set up a free consultation with our advisors, including John and Mike here at New Harbor. Just stick around at the end of the video. It's coming up in just a few seconds. We tell you how to set up one of those absolutely free consultations. And wrapping up here, guys, one thing I want to let everybody know about is I just got put on my radar a great event that's coming up. It's got over 50 of some of the absolute highest quality financial experts that I've ever seen brought together for a single event. It's got several people that have appeared on this channel before, whom we all like and respect, but it has a ton more people that I've not yet been able to attract in our orbit. And like I said, this is one of the best aggregations of economic and financial minds that I've yet seen in a single event. This is at John Malden's Strategic Investment Conference. And if you just go to wealthion.com/SIC, you can see all the details there, but I just got briefed on it by that team. Right now, if people sign up, you get a massive discount. I think it's like 44% or something like that. So go check it out, see if it's something you're interested in. But I'm probably going to be getting involved in that. In fact, I'm definitely going to be getting involved in that now that I've been briefed on it. And I wanted to flag it for all of you viewers, because I know people enjoy, not only learning from great minds like that, but there's apparently a number of interactive opportunities too, where you can ask your questions directly of these people during the live events and stuff like that. All right, guys, in wrapping up here, John, I'm going to give you the last word here, because you guys talk to people week in, week out, and Mike, feel free to chime in too. But you guys have your finger on the pulse of what today's investors are thinking about: hopes, dreams, worries, etc. Any bit of parting advice based upon the discussions you've been having over the past week with the people that have been calling into you?
Well, folks are obviously concerned about what's going on in the world. It doesn't take too far a glance at headlines, and they see the volatility in markets, even just in kind of broad broadcasts on the nightly news and whatnot. But generally speaking, I think our clients have been pretty at ease in that, with our defensive positioning, their accounts have been pretty stable and actually kind of bucking the trend in many cases. So we're happy about that, and our clients, I think, can rest a little bit easier. I'll let Mike kind of share a little bit of the perspective of, we're fortunate to have lots of conversations with prospective clients, which is a different kind of conversation than the ones we have with our longtime clients. So I'll hand over to Mike to give some thoughts there.
Yeah, I mean, it's like this bubble, or this overvalued market's been going on so long that I'd say most of the people in the last few months have been relatively conservatively postured, before they came to us, or a common question is, I've got a high amount of cash, in my account, but I just don't know how to get back in. What should I do to get back in? And these aren't people that have necessarily been out since 2008. I'm talking about people that maybe got out last year thinking, boy, well, this thing is really long in the tooth, or the year before. And of course, it's only kind of, it had a blow off and it went higher and reached a high near the end of 21 or early 22. And now it's down 7% for the year. But like John said, it's nothing. It's a tiny little speck compared to how egregiously overvalued this market is. And so people want to have a plan for how to get back in. And I think we give them some guidance on that. And my guidance right now would be, don't be in a rush to get back in. If history's any guide, and it should be, we probably will have a very big bear market. Jim Rogers was on not too long ago with you, Adam, and we were there too. And he said, I expect the largest bear market in my lifetime. And we think he's probably right.
Yeah, and just to interrupt you here, but Michael Pinto said pretty much the same thing. He said, we're going to see the biggest bear market that any of us have lived through.
You're correct. He did say that. That's right. So don't be in a rush. Take your time. Don't fret about it. You're not going to have to hop on the next V-shaped bottom, in our view. And even if it is a V-shaped bottom, we think that fair valuation is quite a bit below here. We can offer some guidance, and we offer a system on how to get in. We know how to use options. We can sell premium to hedge a kind of a systems-based entry into the market. And so we can offer that. And I think that people want to understand how to do that. But my short answer is just don't be in a rush. And, we'll be talking every week about what we're doing and what we think. So just continue tuning in to programs like this.
All right. Wise counsel, guys. All right. Thanks so much. All right, everybody watching, if you enjoyed this interview with Michael Pinto, if you'd like to see more great guests like him on the program, please just support this channel by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. And if you have any interest, again, go to wealthion.com/SIC to learn more about that strategic investment conference lineup. John and Mike, thanks so much for taking another week to clarify and advance the understanding of all of our Wealthion viewers here. Everybody else, thanks so much for watching. See you guys next week.
It was a great pleasure. Thanks, Adam.
Thanks, Adam. See you next week. Thanks.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market will always take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.
We are here in Omaha, Nebraska this morning with Warren Buffett, the chairman and CEO of Berkshire Hathaway. He's just released his 55th annual shareholder letter to the shareholders over this weekend. And this is actually the 13th year that we are now in Omaha talking to him after that letter. This is a show that we call Ask Warren, so that people can write in their own questions to Mr. Buffett after they've read that shareholder's letter. But obviously this morning, given the news, there are a lot of other questions that people have concerning the stock market. Let's jump right into it with Mr. Buffett, who is here with us right now. And Warren, thank you for being here today. It's good to see you.
Thanks for having me.
I want to talk about the letter. Obviously, one of the things that you touch on in the letter is when people should be buying stocks. We're going to dig into a lot of it, but when you're looking at the futures down about 818 points this morning, I think probably the first thing viewers want to hear from you are your thoughts on what's happening with the coronavirus, if this is a reason to panic, and if you are worried about this.
Well, I don't know I have any special thoughts beyond the news on the coronavirus. The very first day I bought stocks was March 12th, 1942. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning, so when I came home in the evening and my dad told me the execution price, it was down 2%. But if you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably, you're going to buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own, American Express, we've owned it for 20 years, Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like and you can buy it even cheaper, then you're good luck, basically.
Although there are a lot of people who look at the market and they say, look, I want to buy, but I don't want to buy when the market's sitting at new highs, when it's been hitting new records every day. Maybe it's off 800 points this morning, but maybe there's more of a decline to come because the effect of the coronavirus is going to be an impact on the global economy. IMF said that over the weekend. You are going to see weakness as not only China, but other countries try and address this. You're right, it may not change things over the 5 or 10 year span of things, but if I think that I can buy something for potentially 10% cheaper, maybe more than that if I wait a week or a month, maybe that's what I'm sitting around.
Well, if you think that, then you're going to get fabulously rich if you're right. All you have to do is just keep buying at 10-day intervals and keep taking your 10-day prediction. If I knew what the market was going to do, obviously, but you don't. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. Everybody, when they buy a stock, if you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page, say, let's say it's selling for 30. It isn't selling that low, but that'd be 42 billion. You should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower in it. But you don't have that.
But if I worry that the economy is going to slow down, not just for the quarter, but for the year, that would impact how many cars I think they might be able to sell or even produce.
I'll guarantee you cars are going to slow down someday. In 1932, General Motors had 19,000 dealers. That's more than all the auto dealers in the United States today. There are only 125 million people then, but they had 19,000 dealers. They produced or sold, and there was 1 month, I think, when they sold less than 1/10 of a car, right at 1/10 of a car per dealer. That was a terrific time to buy General Motors. and forget about the market. If you can predict the market, you don't need to read balance sheets. You don't need to read anything. You certainly can't predict the market by reading the daily newspaper. That is for sure. And you certainly can't predict the market by listening to me. But you're buying businesses. And if you had planned to buy a local service station yesterday and it was closing day, I don't think you'd tear your hair out or anything like that. You'd have already looked at where it was located and the contract that it had with the suppliers and made a decision on competition. people, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or investment in an apartment house. But it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment. And you can't pick them from day to day. If you can do that, you can, well, I haven't met anybody yet that knows how to do it.
You made a point of that in the letter this year, where you highlighted a book that was written by Edgar Lawrence Smith back in 1924. And you said until he came along, nobody really realized the compound interest effect of buying stocks, not just buying businesses, but buying stocks themselves.
Edgar Lawrence Smith changed the world with that book, and the people have forgotten all about it now. Although in the 1920s, it became more and more gospel as the boom went on. But Edgar Lawrence Smith set out to write a book on bonds versus stocks. And he said if he went in with the idea that bonds would be a better investment in times of deflation and stocks would be a better investment in times of inflation. And the first line of his book was to say that he'd been wrong. But he had enough sense to look at his evidence. I think Darwin said if you found evidence that was contrary to what you already believed, write it down in 30 minutes or your mind will just block it out. I mean, people have a great resistance to new evidence. And he said, if a stock yields 4% and a bond yields 4%, which was what he was talking about then, the stock was going to outperform the bonds because there were retained earnings that were building beyond that yield. And that had been true for a long, long time, but nobody paid any attention to it. We don't get rich on our dividends that we receive, although we're happy to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company. And Berkshire has retained earnings ever since we started. That's the only reason Berkshire's worth a lot more, is we retain earnings.
That led Keynes to actually say that this was an important book. People paid attention to it, but you're right, it added to the frenzy that built up to 1929.
Well, that is true, because you can get, old boss Ben Graham told me very early on, you get more trouble with a good idea than a bad idea, because the good idea works. I mean, it's a good idea to buy a home, for example, and then people go crazy. The good idea works, and it works, and it works. Stocks work out better than bonds most of the time. And after a while, people forget that there were some other limiting conditions. With Edgar Lawrence Smith's book, it was that when bonds yield the same as stocks, which was the case then, that stocks are going to outperform because they have this retained earnings. So stocks started going up in the 20s, and all of a sudden they were selling at 5 or 6 times the prices as when he bought the book. And the original correct perception on his part had experienced changing conditions, but people just looked, they got their confirmation through stock prices. And people, that's what happens in bull markets. People start out thinking stocks are cheap, and then they start thinking stocks have gone up. And a stock can be a good buy or a bad buy. A bond can be a good buy or a bad buy. It depends on price.
But that leads us to today. I mean, if his premise was that stocks are always going to be a better investment than bonds, that's kind of what you hear today, which we've been hearing for a while, is Tina, there is no alternative, right? You have to buy stocks because bond yields are so low, because interest rates are so low.
Well, if you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case. I mean, but it's usually been the case in America, very usually been the case. And if you buy a 30-year bond today with a yield 2%, you're paying 50 times earnings for an investment where the earnings can't go up for 30 years. Now, if somebody said, I want to sell you a stock that's at 50 times earnings and the earnings can't go up for 30 years, you'd say that doesn't sound very good. Stocks are way better than 30-year bonds. I mean, that's clear. And that's one of the alternatives people have. People really have 3 basic alternatives: short-term cash, which is an option of doing something later on; long-term bonds or long-term stocks. And stocks are cheaper than bonds.
Charlie said recently, Charlie Munger, the vice chairman at Berkshire Hathaway, had his daily journal meeting just a couple of weeks ago. And at that meeting, he said that there's a lot of wretched excess out there and that there's a lot of trouble coming as a result. Do you agree with that?
There's always trouble coming. You know, there was trouble coming in 1942 when I bought that first stock, all kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks.
Would you repeat that this time? If trouble's coming, would you still say buy stocks right now?
I would say buy stocks if you get enough for your money. And, you know, we buy a few stocks, but we don't look at, we're not buying the stock market. We're saying, I am buying, let's say American Express. We own American Express. You know, there's 815 million shares out and sells it. This morning's 126 or something like that. So it's selling for roughly $100 billion. Now, the real question is whether the company's worth more or less than $100 billion. It isn't what the stock is going to do tomorrow or next week or next month.
You said just a few minutes ago when we asked you on Worldwide Exchange, right now Berkshire Hathaway is a net buyer of stocks. You are in a net buying position?
We've been a net buyer of stocks, or I've actually been a personal net buyer of stocks ever since I was 11, every year. And there's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. Now, I haven't bought stocks every day. There have been a few times I thought stocks were really quite high. And I've even written an article once or twice, but that's very seldom.
But you wrapped up your partnership at one point,
I wrapped up my partnership once.
Because you thought it was too expensive?
Yeah.
Okay. But this is not a time like that?
We own $240 billion worth of stocks. Now, we look at that as $240 billion worth of businesses that we own parts of. But I love owning those businesses.
You've also got more than $125 billion in cash sitting around.
Yeah, well, we'd like to buy more businesses.
We are here, Warren, with you at Berkshire Hathaway's headquarters building. This is upstairs in the room that's called the Cloud Room. And this is a room where you often take students to kind of talk to them about questions they have when they come to visit you. You also do some other things up here, too, other presentations.
Yeah, I had students here for dozens of years. And for many years, 40 schools would come in. They'd come in groups of 8. At 5 days, I'd spend a year. And they come from all over the world. We had them from Peru. We had them from China. We had them from Israel. And we had a good time always. I've given it up now, but I started teaching when I was 21, and when I got to about 88, I thought, I'll take a rest.
Well, there are a lot of questions that are coming in from viewers that have been hitting here today. They're waking up this morning looking at the stock market indicated down by almost 800 points for the Dow. We're actually off our worst levels of the morning, which is something to say when you're still looking at the Dow down by about 786 points. But people have a lot of questions about the economy. They're wondering what's happening right now, particularly with the coronavirus out there. You have a lot of economic data at your fingertips because not only are the many businesses that Berkshire owns, but the businesses you own pieces in. What are you seeing right now around the globe?
Well, it affects various businesses. I would say that I received commentary. I get some commentary monthly from almost all of the companies, and a good many of them had some comment about how it was affecting them, and however it was affecting them at that time, I'm sure it's accentuated. But they were affected by tariffs, they're affected by taxes, they're affected by, the most thing is they're affected by competitors and supply and demand over time. And I don't have the faintest idea what our businesses will be doing 6 months from now or 12 months from now. I do think that not only our businesses, but American business generally will be doing fabulously better 30 years from now or 20 years from now. And the long term is very, in my view, is very easy to predict in a general way, but in an important way. I don't think there's any way to predict what the stock market will do 10 minutes from now, 10 days from now, or 10 months from now. So I work on what I think I'm able to do, and as desirable as it might be to know what was going to happen 10 minutes from now, that's just not something I'll ever be able to master. So fortunately, I can come to a pretty firm conclusion that 20 or 30 years from now, America business, and probably over the world, will be far better than it is now.
What are the momentary implications that you've seen from coronavirus? What's an example of a business?
Well, an example, for example, we have maybe 1,000 Dairy Queen franchises in China here, and they're just treat only, so they're the older type, not with food. But a great number of them were closed, but the ones that were open weren't doing any business to speak of. And Apple is, I mean, our much bigger holding is Apple. We own 5.6% of Apple, and the company came out and said that it's affecting not only its stores, but all kinds of things, supply chain. And I find that certain of our companies have got supply chain arrangements that are being affected by this that I didn't even know had those.
Like what?
Well, I got one from Johns Manville the other day, for example. You wouldn't normally think of them as having a big supply chain, but Shaw Carpets or you name it. I'll guarantee you that a very significant percentage of our business is one layer affected by, but they're being affected by a lot of other things too. And the real question is where are those businesses going to be in 5 or 10 years? They'll have ups and downs. Our candy business is a wonderful business, but it loses money 7 months out of the year. But the nice thing is Christmas comes every year.
When you look at the economy and how things were kind of chugging along, let's say beginning of this year,
yeah,
when things first picked up, how would you gauge the U.S. economy at that point?
Well, it's strong, but a little softer than it was 6 months ago. But that's over a broad range of business. You look at car loadings, rail car loadings, that's moving goods around. And there again, that was affected by the tariffs too, because people front-ended purchases, all kinds of things, always a lot of variables. But business is down, but it's down from a very good level. So I would say that looking at our 70 businesses, and that actually, they represent hundreds in addition, they're a little softer. On the other hand, I was out with the fellows from the Nebraska Furniture Mart just Saturday night, and their business was up quite a bit in February, but that's because weather was good. So you have a lot of variables that hit.
Why do you think business was down, let's say, the last 6 months? Is it a decline in confidence, or is it coming off of levels where there was unusual activity ahead of that?
Well, it isn't really down. It's just it leveled off and a little softer maybe now. But, well, tariffs, the tariff situation was a big question mark for all kinds of companies and still is to some degree. But that was front and center for a while. Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now? Some of them will do sensationally, some of them will disappear, and overall, I think America will do very well. It has since 1776.
But you still watch things like rail car loadings very closely.
I watch everything, but I don't do it to make specific investment decisions. But I enjoy it. I mean, I want to know what's going on. But I also don't think that I can make money by predicting what's going to go on next week or next month. I do think I can make money by predicting what's going to happen in 10 years.
All right, well, tell us more about what's going on, just since you like knowing about those things.
Well, as I say, the certain businesses depend on weather to quite an extent in retail, for example, in given months. But the big trends you see are going on. I mean, in terms of the movement to online commerce, and I mean, the big stuff keeps moving. But we've got a big investment in the airline business, and I just heard, even more flights are canceled and all that. But flights are canceled for weather. It so happens in this case they're going to be canceled for longer because of coronavirus. But if you own airlines for 10 or 20 years, you're going to have some ups and downs in current business, and some of them will be weather related, and they can be all kinds of things. The real question is how many passengers are they going to be carrying 10 years from now and 15 years from now, and what will margins be, and what will the competitive position be? But I still look at the figures all the time. I'll admit that.
You mentioned the airlines, and you own stakes in all of the major airlines, but none as much as Delta. I think you own north of 11% of Delta at this point?
Well,
right.
We own our largest position is in Delta. 3 of the 4 positions are mine. 1 of the positions is one of the other fellows of the 4 positions. But we own a very roughly close to 10% of the 4 largest airlines.
There's been a lot of speculation. In fact, some of the questions that came in over this weekend were questions about those airlines, wondering if you would buy any of them outright. Have you considered buying any of those companies outright?
It'd be very unlikely we would do that. I'm not saying it's impossible, but it's complicated.
Why?
Well, for one thing, they're regulated, and there's an interplay. I'll just give you an example, not that we'd be doing, but with Delta, we own 18% of American Express, and American Express is a bank holding company, and bank holding companies have limits as to what they can do, and we're a passive holder of a bank holding company with American Express. But then if we owned an airline that was tied up with them, they'd have lots of arrangements. There's a lot of complications because it's a regulated industry. Anytime you get in a regulated industry, you have more complications in transactions.
So is it fair to say you like these stocks and you would own more if it wasn't complicated?
Well, to go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. I mean, there's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of.
Are you buying more of any of those stakes right now? Apple
Well,
shares?
I get pretty close-mouthed when it comes to what we're buying.
You thought about that for a
I feel
second.
my jaws lock up.
But fair to say,
it's fair to say that anything that we own, we like. There's very few stocks that we own, and I look at them as part ownerships in businesses. There's very few that are selling at some price where I would sell them a little higher.
all right, well, let me ask a question that came from Tony Dickinson. He said, in the fourth quarter, Berkshire sold 55 million shares of Wells Fargo. Should shareholders view this as a lack of confidence in the new CEO turnaround plan, and what is Warren's future outlook for Wells Fargo?
Well, I won't give him any advice specifically on Wells Fargo, but it's absolutely true that we've sold down our position. Some of it was sold down to avoid being over 10%, because then you do have some filings with the Fed and so on. But
They've sold well more than that.
Yeah, we've sold well more than that.
I think 8.4% was the last.
Yeah, that sounds right. And no, we sold Wells Fargo in the fourth quarter, and we sold it earlier.
Can I ask why? Only because I did get a number of questions.
Yeah, well, I can understand that, but we just don't want to give any advice on what we're doing, because I could change what I'm doing tomorrow. We talk about everything except we don't give stock advice.
Okay. I'll try one more from Tony Dickinson, just because I think I got 15 or 20 different questions on this. Berkshire owns $32.58 billion of Bank of America and $17.39 billion of Wells Fargo. One position's been increasing while the other's been decreasing. Does Warren like Bank of America twice as much as Wells Fargo? And how should shareholders view the holdings?
Yeah, well, I think they've seen that we bought Bank of America and we've sold some Wells Fargo.
All right, let me ask you a broader question that comes in just on interest rates
Sure.
and the impact that might have as well. Varun Jane writes in on Facebook, hi, I'm a huge fan and a student of Mr. Buffett. Please ask him, what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good, and does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, et cetera? And in such circumstances, do Indian banks, which have high return on equity, look attractive to Mr. Buffett?
Yeah, well, I can't comment on that latter, but generally speaking, with there are a lot of other variables too, but the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well.
If you are talking about the curve that we're looking at this morning, the 5-year, 2-year is inverted. 2-year 10 is not right now, but the 10-year is below 1.4% this morning.
And think of it, the 10-year at 1.4%, that means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
now, if somebody came to you with a stock and said, you know, this is a terrific stock, it sells at 70 times earnings, the earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But No, we've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones. And they don't talk about negative interest rate. It never crossed their mind. How much supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. I mean, we've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation, and well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has.
You made a point in the letter of saying that you don't know how long these interest rates will last. Right. You and Charlie never try and figure these things out. But we did have St. Louis Fed President Jim Bullard on the program last week, and he said that he expects to see these low interest rates for a long time to come. That does raise a lot of questions, if that happens, about what this means for the stock market, what that means for banks, what that means for insurance companies, which you touched on in the letter too.
It's bad for insurance companies, but it's good for stocks.
Bad for insurance companies, and what happens to the insurance companies as a result? Are they getting more?
Well, it depends.
Are some insurance companies kind of pushing out risk?
The ones that really get hurt on it are either life or annuity companies that have promised returns. The property casualty business doesn't promise returns. It still holds money, so it hurts them. But if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear.
Are insurance companies being forced to make riskier and riskier bets?
Well, they shouldn't be. I mean, the answer, if you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I saved all this money all my life, and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%.
Do you think, though, that's what should be happening? Do you think that there is more risk taking place in the insurance market as a result?
You see that in what they call leveraged loans and weaker covenants. No, people are reaching for yield. There's no question about that, and that's stupid, and it has consequences over time. But it's very human.
Consequences that could have a big market impact.
Depends how far it goes. Yeah. It's something that the things that get built in slowly, people going crazy in tech companies in the late 1990s, it can take a lot longer than you think. Mm-hmm. But eventually you get to midnight and everything turns to pumpkins and mice.
You know, that's the downside of low interest rates, pensions, savers, anybody who gets left in a raw position of that. On the alternate side of things, if rates were to rise rapidly, or maybe not even so rapidly, what does that mean for the federal debt?
Well, it depends on the average maturity of the debt, but our maturities are fairly short. They've gotten lengthened a little. But if you take 20 trillion and you're borrowing at 2%, you've got 400. What have you got? 2 trillion, 200 billion. You got 40 billion of the expense. But if goes to 5%, you got 100 billion of expense. I mean, no, at 5%, you got a trillion of expense. I'm sorry. It's we are benefiting enormously in our national budget by the fact that interest rates are very low, and so interest cost has not gone up as you would have anticipated if you were looking at the scene 20 or 30 years ago with the increase in national debt. Austria issued 100-year bonds, at 2% or thereabouts, and then they've gone way, way up. And I think maybe they yield 1.1 or something like that. I don't know where they are now. But it's great if you're a borrower to have cheap money. I mean, everybody should refinance their mortgage.
Is that an argument for the Federal Reserve, or I'm sorry, for the Treasury Department here, issuing longer notes?
Well, yeah, but I would have said the same thing 5 or 6 years ago and been wrong. But if we, under the present slope, it still would cost more to lengthen it out. But you're lengthening it out at very, very low rates. And it would be what I would be inclined to do if I were Secretary of Treasury, but I'd have missed a lot of bets in the last 10 years too.
Warren, again, for people who are just waking
Sure.
up, they're tuning in and they want to know what you think about this sell-off this morning. To see the Dow down 700, 800 points in the morning,
Yeah.
what's your reaction when you see something like that?
Well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, I prefer it. So if that's a roughly a 3% decline or thereabouts. I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. And I can't think of one that you shouldn't have bought on, basically. That doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheaper. I mean, but how can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it can be 2% less than they offered you yesterday. But if you like the house, it really doesn't make any difference to you.
Does that mean Berkshire will be buying stocks today?
Well, we certainly won't be selling, and yeah, we could easily be buying something, sure.
Okay. Let's talk a little bit about a Barron's cover story that was just out last week. The good news on the cover story is they think that Berkshire is worth more than it's selling for right now. The bad news is they said they think that's in part because it's got a big conglomerate discount, and they think if you weren't running it, that it might get broken up. What's your response to that line of logic?
Well, conglomerates have had a bad name, and for good reason over the years. I mean, I closed my partnership up at the end of the 1960s, and there was a very abusive run in conglomerates where they played with numbers and they had dirty pooling, as they called it, of accounting. They wanted to have their stocks up and put out stories to do it so they could issue more stock. They were kind of chain letter arrangements. There've been a lot of bad conglomerates, and probably disproportionately so compared to sort of honest to God single industry businesses over time. We don't think we're that kind of a conglomerate. We've certainly never wanted to issue shares. We've never touted shares. And it's done for business reasons in our case. The interesting thing is, of course, is the American public has been going wild in their enthusiasm for conglomerates in the last few years, if you think about it. I mean, it's been an incredibly popular area, but they call them index funds. Oh. You buy 500 businesses.
Trying to figure out what you were talking
about. Yeah, well, 500 businesses all put together. I mean, that's the ultimate conglomerate, isn't it? I mean, I've recommended index funds to lots of people, and when they do it, they're buying into 500 businesses. And they're going to have 500 businesses a year from now and 5 years from now, and they think that group of businesses that will do very well, and I think our group of businesses will do okay.
The difference with an S&P 500 index is it's 500 different companies run by 500 different management teams who are all focused on their business, maybe not having a centralized operation that is loosely running all of those businesses.
Well, our businesses are run by separate people. I mean, we just finished Valentine's Day, and I did not select what pieces went in the boxes, and it's probably been 10 years at least since I've been to a Seas cannery factory. Now, I get the figures every month, but I don't know how to make chocolate, anything of the sort. I don't pick out the new locations. We have managers for our businesses that are very much like the managers we have for the businesses that we own pieces of, like American Express or Coca-Cola. And there's a couple things we can do. We can determine the dividend policy of our subsidiaries. We can control their capital allocation to some extent, but on most capital allocation, whether to buy new equipment or anything like that, they make the decision. The BNSF Railroad is going to spend $3.5 billion on. I don't approve a single dollar of that in terms of capital expenditures. They know what they need to do, where they need to lay track, how many locomotives they need, whatever it may be. So our managers are, I would say, in a sense, they're almost more independent than the managers of the S&P 500 who go around and report to Wall Street week after week. They go to investor relations meeting, and they're always explaining what they're doing and trying to get the approval of the analysts and all that sort of thing. And we just tell our managers to do what makes sense.
Okay, outside of the idea of them not having to report to individual shareholders or the investment community, what's the advantage of having you there? The capital allocation part of it?
Well, we can move capital within. If you move capital from one stock to another, and you got a gain, particularly, I mean, you pay a tax, and may pay a dividend tax, or if you sell, but there's a lot of taxes incurred in moving from one business to another, either at the corporate level, in some cases, but certainly at the individual level. And we can move capital. Well, just take See's Candy again. We bought that in 1972. We've moved several $1 billion from the candy business to other types of businesses. And we'd love it if we could use it all in the candy business, but it just isn't that sort of business. And in addition to that, we free up our managers from all dealing with Wall Street, dealing with bankers, dealing with all kinds of things that are what I regard as less productive use of their time.
However, you also have a situation where you have gotten some activists who have been interested in the stock, including Bill Ackman. He's built up a stake, hasn't said too much about it, but I think he has made some comments about how maybe Burlington Northern Santa Fe's margins could be improved. You can look back at Bill Ackman's experience with the Canadian Pacific Railway and kind of wonder if he is building up a position because he would like to see you take a more active role there.
Well, we notice what other railroads earn and when their margins are better. I mean, and we certainly put way less pressure on than Wall Street might, who would want it next week. But our managers are well aware of what's going on in other industries, and we've made changes where we don't think some businesses are performing as well as they should. But overwhelmingly, we've got managers there that are very, very good. They've got capital available to them for anything that makes sense. And we decide how much they distribute, where the capital moves, and sometimes it moves from one industry to another. And in certain industries, a consolidated tax position really is very helpful to us.
There's a viewer question that came in from Ben Compston, and he asks, it was recently pointed out by Bill Ackman that some subsidiaries like Geico, BNSF, lag their peers in some areas. Would you agree with that? And how can your successor push improvement in subsidiaries while maintaining a decentralized management structure?
Well, at Geico, we bought control in 1995. We had about 2.5% of the market for auto insurance, and we're at about 13.7% of the market. So we've gone from $2.5 billion of premium volume or thereabouts to $35 billion of premium volume. We're number 2 now to State Farm. We were number 6 or 7 at that time. So I would say that not due to Berkshire at all, but due to Tony Nicely during almost all those years. Geico's been the envy of every other company in the auto insurance business except for Progressive, but they've done a good job too. But Geico is worth tens and tens and tens of billions more than when we bought it, in addition to all the earnings we've given, just the goodwill value. So that's been extraordinarily well run. And with Burlington, I think we paid a dividend of $5 billion last year, and we paid $35 billion for it. So it's gained in market share in its business. Its operating margins have improved, but they haven't improved as much as some other railroads.
Do you believe in precision scheduling railroading?
Well, we'll see. I mean, we've watched it plenty, and
for those who don't know what that is, it's something that kind of irritates customers because it makes things a little more rigid, but it does improve.
Yeah, it makes the customers adapt to the railroad more than the railroad adapting to the customers. And practically everybody's done it. And a fellow named Hunter Harrison was enormously successful.
Who worked with Bill Ackman at the Canadian Pacific.
Yeah, he worked for the BNSF, if you go back far enough. And there's a book about him. It's very interesting. But he did it at the Illinois Central, the Canadian National, the Canadian Pacific, and then he was going over to the CSX. He developed a method of railroading where the customer does adapt more to the railroad, and it improved margins dramatically. Our margins are close to what the better railroads, well, there's only a few, get from precision railroading. On the other hand, we've gained share.
Because the customers don't like
because the railroads apparently, or the railroad customers like us better. And over the long term, we'll see. But it isn't like it's something we can't do.
And here's the latest on the coronavirus. China reported an additional 150 deaths and 409 new cases overnight. South Korea raised its coronavirus alert to the highest level after the number of cases there ballooned from 31 to more than 750 in less than a week. Stocks in Asia falling overnight. Hong Kong's Hang Seng fell 1.8%. South Korea's Kospi fell nearly 3.9%. Shares of South Korea's two largest airlines down as they canceled flights to the city of Daegu, where many of the new cases were detected. Meantime, Italy's government is scrambling to deal with the biggest outbreak of the coronavirus outside of Asia. Stocks there were lower overnight. The government placed at least 10 towns in northern Italy under quarantine and canceled the last few days of the Venice Carnival. Elsewhere in Italy, schools, museums, universities, and cinemas were closed, and major soccer matches were canceled. At this point, I mean, Boris Johnson out earlier today, Andrew, saying that the risk to UK citizens just over there remains low. I would say that our officials would say that here too. The risk to the U.S. citizens remains low. But there's a significant difference between supply chain disruption slowing dozens and dozens and actually hundreds of companies.
Absolutely.
And that's dampening global growth. What worries me is that we don't know 3 months, 6 months, 9 months. If it ever gets to the point where we start to see, in a lot of countries around the world, these breakouts where they don't even know the origin of some of these, and if they multiply like that, that's when I think it could really get. At this point, it's still a global growth slowdown. Nobody in most of the world is worried that they're going to catch coronavirus, and they can't go out and they can't go to the movies or the health club or to a restaurant. But that I just wonder. Look, we don't know.
There are major travel that's being changed right now. Conferences are being canceled. There was an article in Time magazine speculating whether the Olympics in Japan over the summer will be canceled. So there's real implications here that could reverberate. Having said that, the farther we get to the spring, the better it gets in terms of weather. There's a whole sort of view about how the flu,
I was looking at some of Jim's tweets earlier. If you go too far with the fear and the panic, you're accused of one thing. If you don't go far enough, you're accused of the other thing. So we really just need to sit here and each day report on the facts and try to remain detached. But there's something about a pandemic that just is different than other black swans. It's a frightening prospect. Anyway, let's get right back to our guest of the morning. Warren Buffett joins Becky in Omaha following the release of his annual letter to shareholders over the weekend. Becky, you took a plane. I mean, it's in the back of our minds, is it not? It's just in the back. There's no way around. And the risks are low.
So it goes back to 1918. It goes back to 1980. If you look at the numbers of what happened in that pandemic when it came around the globe, up to 50 million people were killed in that. It was a third of the planet's population that was infected. It was 500 million people that were infected at that point. 675,000 Americans died at that point. So inevitably, your mind kind of goes back to what's happened in the past, because as humans, we always look back to history to try and predict the future. It doesn't always work. It's not always prophetic, but it does give you something of what to kind of play out if this were to get worse and worse. Now, Andrew brought up the idea that it's warm weather. We're approaching spring in a lot of parts of the country, or a lot of parts of the planet. That may be good news. We just don't know if this time around, if this is one of those viruses that does die off in warmer weather. Wait and see and kind of hope.
Yeah, actually, I think this, from what I've heard from people that know a lot more about viruses than I do, that unfortunately this will make it through the summer, and in terms of having a vaccine, it's a long ways off. So you've got it is scary stuff. I don't think it should affect what you do in stocks, but in terms of the human race, it's scary stuff when you have a pandemic.
Yeah, I guess this one's particularly frightening because it's new. So there's no natural immunity that's built up in any of the populations. And you wonder what happens, particularly in areas where there's not the same healthcare structure that we have in America or in some of the developed nations. I guess that's a big part of the question, too.
Yeah, and it's well, I think about it in terms of our annual meeting. I mean, which is May 2nd. I mean, it could very well affect, by that time, it could affect.
We got questions from viewers asking just that. Will the annual meeting be any different this year, particularly because you have a large Chinese contingency of shareholders who come here for that?
Yeah, and that certainly will be affected. And incidentally, I mean, flu is particularly tough on old people. If you're going to have two guys on the stage whose combined age is 185, so we won't be looking for people that are showing any signs of contagion. But that's one of the problems with this, is it does have a long gestation period,
right.
And it's highly transmissible.
And again, you did talk about it earlier. It's something that you see in the results of the businesses, even some of your own fully owned businesses that you didn't anticipate.
Well, and we own airlines, for example. No, it affects businesses. Now, actually, my dad used to tell me stories. He was 14 in 1918, and he told me what went on in Omaha, during the big Spanish flu epidemic. I mean, it was something in those days, and pandemics will occur in the future. Now, what they hope to get is a universal flu vaccine, but that's a long way off. It isn't impossible. I mean, I asked my own science advisor is Bill Gates, so I talked to him. I call him. I've talked to him the last few days about it, and he's bullish on the long-term outlook for a universal prevention of it. But he says it's not going to come, it's not going to be here in 10 years.
What are Bill's concerns as somebody who spends a lot of time traveling around the globe, as somebody who is trying to help medicine in some of the less developed parts of the world?
Yeah, the Gates Foundation is very active in trying to be helpful on this, and Bill says the CDC is the best in the world, and I mean, we've got terrific resources in this country, but a pandemic is a pandemic, and there's just no evaluating. But I have heard that the summer is not likely to cause the end of this.
Do you know why?
But I don't know, and you shouldn't be asking. I shouldn't be offering my opinion on that, because I pass along things I hear from people I think are smart, but
I'm actually asking for Bill's opinion, not yours.
yeah, well, I shouldn't really quote him, but I do. He's the guy I ask, and I did talk to him just a few days ago, and he loves to talk science, and he can make it so I can understand it, which is quite a trick. At the Gates Foundation, they're taking it very seriously. I'll put it that way.
Is money going from the Gates Foundation to try and find a vaccine?
I'm sure we're expending human and financial resources.
I mean, maybe this is more than you know, but do you know if they have put human resources out either into China or other places where there's...
I don't know that. I don't want to comment on that, but I know that that is something they've always spent. They've been very involved in is human health, and even particularly this. Bill knows a lot about vaccines.
Okay. Let's talk a little bit about Berkshire Hathaway. We were in the middle of a conversation when we had to go to a break before, but there has been this question raised, not only by Barron's in the cover story there, but by other places too, about whether Berkshire Hathaway would be worth more if it were split up.
It's a good question, and I will tell you that if you were to say, and let's say the stock market didn't change for 2 years and interest rates didn't change. So you had a 2-year period and you said, we'll sell off all the businesses. I don't think, I mean, you have the expenses of selling them. Now, if you sold them all to people who leveraged them up to their maximum, you might get a little more than the stock is selling for. It would be very tax inefficient, very tax inefficient. Interestingly enough, up till 1986, it wouldn't have been. I mean, there was a general utilities doctrine that governed corporate breakups. And so you could dispose of businesses or securities, if you did it right, you could dispose of securities or businesses that had appreciated without a tax at the corporate level. That was done regularly in various ways up till 1986. They revised the tax code big time. They killed general utilities. You can't do that now. Now you can have spin-offs, this business or that business. You probably have to lie a little in terms of your purpose in order to get the best tax ruling. And it takes time, but you cannot break up, you cannot dispose of the entire business, business by business, without having very substantial tax liability. It would not produce a gain. On the other hand, having them together produces, there's some very valuable synergies in there. Now, we don't use leverage as much as the people who would buy them piece by piece would do. So we could leverage Berkshire up to the sky. I've promised people we won't, because we have insurance promises to people out 50 or 100 years, and we've got shareholders who are going to own the stock for 50 years, and they do not want us to leverage to the sky. But there would not be a profit if we were simply to announce that over the next 24 months that you could come in and buy any business we had and we'd sell them to the highest bidder.
You made a point of talking about this in the annual letter. You said, key to my Berkshire-only institutions is my faith in the future judgment and fidelity of Berkshire directors. They will regularly be tested by Wall Streeters bearing fees. At many companies, these super salesmen might win. I do not, however, expect this to happen.
That's exactly true. And I think by writing it, it helps it a little too. No, there's no question that Wall Street would love to come along and sell anything that we've got. I mean, there's a fee every time that there's a transaction, and they're big fees, and there's fees for financing. I mean, so we've had all kinds of people snoop around that. They know they're not getting it done with me, but it won't get done later on either. I am leaving every share of Berkshire I have goes to charity, and it's 99% of my net worth. So nobody cares more than I do about getting the most money to those philanthropies over the years following my death. And that's going to take place over 15 years. And I say keep it all in Berkshire. But if I thought that it was going to be run in a way responsive to Wall Street, I would instead do something else and have the money distributed to these philanthropies and not have it all tied to Berkshire. But Berkshire has a very unusual shareholder base. I mean, we have individuals that own Berkshire, and a lot of them have owned it 50 years just like it's people buy it to own for lifetime, and we're going to run it in a way that they won't be disappointed.
Do you think the people who are relatively newer shareholders buying the B shares have the same mentality as the people who have been in it for 50 years in the A?
Well, we try to, because that's who we encourage. I mean, in effect, we don't want everybody to buy our stock. I mean, there's only so many seats. There's about 1,600,000 and some thousand A shares out. All the seats are filled. I love the shareholders we have. I don't want to go to Wall Street and try and get some new shareholders. They're going to replace the people we have. So what we want to have is people in those seats that are in sync with us. You can run a French restaurant or you can run a hamburger stand. And if you serve good hamburgers, you'll do good business at the hamburger stand. You can, at the French restaurant, do the same thing there. But you can't run the French restaurant and then serve hamburgers inside. And you can't run the hamburger stand and serve French food inside. So we advertise in our deeds, in our words, in every way we can what we're about. And we're looking to have the seats filled at our church by people who are in sync with us. And we do have them there. We get the same people every Sunday. And I see no advantage in going out and telling everybody in Wall Street we're going to do wonderful things and having those seats replaced, because the only way you can get a seat is to throw somebody else out of that seat. There's only so many seats and they're all full, and you want them filled with people who are in sync with the policies of the company, and therefore you have to explain those policies and you have to live up to those policies. And for 55 years, we've tried to.
So
The Fed put is much lower than it was at any other time. Now I'm telling
you and I have been talking about is that I think there's a lot less room for the Fed to hike rates. And what the Fed's really hoping for, to your point, is that the market, that the economy and the market
Welcome back to Yahoo Finance Live, everyone. As consumers shift their focus to healthy eating habits and combating climate change, vertical farming is gaining popularity. The space is expected to reach $9.7 billion worldwide by 2026, according to research and markets.com. Some scientists, however, are warning about the limitations there. Joining us now to discuss the future of agricultural technology, AgTech. App Harvest CEO Jonathan Webb joins us now. Jonathan, good to have you here with us today. The company also recently reported earnings. When you think about broadly some of the investments that your business is making to really get a larger share of that market, what steps does that mean and how many different facilities do you need to bring online?
Well, this is a challenge that not only the U.S. will be tackling, but the world will be tackling and for the next few decades. So when you say how much do we need to bring on? Well, just to bring tomato production back into the U.S., which currently we imported about 4 billion pounds of tomatoes from Mexico to the U.S. last year, you would need to build 20,000 acres of what App Harvest built in Morehead, Kentucky. Our first facility was 60 acres, about $140 million investment. So you can do the math on we need to build a lot of infrastructure over the next decade, in order to use less land, use less water, and grow more food in the middle of climate disruption.
Hey, Jonathan, it's Julie here. We have talked before, of course, and you make a compelling argument about why this type of farming is going to be necessary, particularly as climate change becomes more acute. The question is how you guys are going to make money while doing it in the meantime before it gains more traction. And so looking at your latest quarter here, you guys did raise prices. Well, of course, we're seeing prices being raised for lots of stuff all across the board. What is going to continue to happen with your pricing dynamic as you guys try to maintain and even grow your margins?
We really don't think we need to be raising prices for the consumer much above kind of where we're at now. It's more about, for us as a company, making sure that we can build and operate facilities, at the price point that's available. You look at, the average U.S. consumer, 50% or more of people going to the grocery store don't have the luxury, to spend more for a premium product. So, what we believe CEA, controlled environment agriculture, our job is to displace dirty open field imports, but do it at or around the same price. But again, if I'm a buyer of that, whether you're a grocer or a fast food chain, the product we offer, you don't have to worry about climate disruption if there's drought or flooding. You don't have to worry about the food safety issues you have on farms south of the border, labor issues, import issues, transportation, food spoilage, all of this that currently hits agriculture hard today is what CEA solves for, and it's all about scale. So for us, we'll have 4 farms open at the end of the year, nearly 8 million square feet of growing area across strawberries, salad greens, and a whole host of variety of tomatoes. And this industry just has to achieve scale in order to hit those price points that the consumers see today.
And at what point in that scale and really broadening out the products that you're bringing to market as well, do you believe that will actually translate into shareholder value as well?
Yeah, it's for us, again, our goal is to carve out the grocery space that is currently being supplied by open field, whether it's imports from Mexico or in the U.S. I mean, look at California. You've got drought, you've got water restrictions from the governor there, you've got Lake Mead drying up, the Colorado River drying up, and where we do grow stuff in the U.S., it's in the Southwest where you don't have water. Then you have imports coming in from Mexico, a whole host of challenges there. So the shareholder value for us is simply build at scale, operate at scale, efficiently run these facilities, and ultimately we believe CEA is the third wave of sustainable infrastructure, and that in 20, 30 years from now, you're going to be growing most fruits and vegetables at scale globally in a controlled environment. And for us at App Harvest, we use sunshine and rainwater, and we think, we run completely on rainwater. We think sustainability is a key driver of price resiliency long term, but using sunshine with our LED lights, using rainwater helps keep our costs down to where we can compete with open field imports today.
Hey, Jonathan, you talked about you guys are doing big expansion, right? You're opening 4 more farms this year. The 5th one I noticed in your release is paused, contingent upon financing. And in this environment where rates are going up, are you finding that financing is tougher to get, and do you expect it to continue to be tougher to get for further expansion?
Well, I mean, obviously in this environment today, it's, everybody is questioning where the world's going in the coming months, but food security is something that continues to be an increasing problem. Unfortunately, what we see in Europe now is highlighting, the instability of our food supply. COVID highlighted it here in the US and around the world, but then you layer on top of that climate change. The capital for this industry continues to flood in. We're seeing a lot of non-dilutive ways to finance this business. We've already secured multiple lines of credit for our facilities to finance the construction. But we're constantly monitoring when the right time is to raise that capital. But ultimately, again, CEA globally, not just in the U.S., it is inevitable. We have to use controlled environment agriculture facilities to grow fruits and vegetables. We use 90% less water and get 30 times yield per acre, and can do that in the middle of climate disruption. We don't have a choice. Our world, we've been taking inbound calls from the Middle East to Southeast Asia, and all around the world, there's a similar concern of how do we keep consistent food supply on store shelves, no matter what the outside circumstances are. So the capital will be there. There continues to be capital flooding into this sector. And again, for us, we see it as, it was renewable energy 20 years ago. It was electric vehicles 10 years ago. And right now we're in the infancy of CEA, and we'll see hundreds of billions of dollars flood into building infrastructure around the world over the next 2 decades.
Jonathan, good to catch up with you. Jonathan Webb is the CEO of App Harvest. Thanks. Let's get a quick check on markets once again, because we are seeing now stocks fall to the lows of the session. Selling is really accelerating here. The Nasdaq is now down by nearly 3%. The S&P off 2%. The Dow doing the least poorly of the three. It's down by 1.4%. And I keep hearing investors, actually, when they are talking about this environment right now, the sentiment is shifting towards capital preservation. And not only that, but losing less in this environment. The guy who, or the girl, who loses the least wins perhaps when everything is down. We're going to dig more into this, of course, as the session goes on. But coming up, Disney earnings are on tap. Could that help? Who knows? What to expect from the media giant after Netflix's disappointing quarter? That's next.
Welcome back. Stocks are at the lows of this session. Let's get right to Yahoo Finance's Emily McCormick over at the Wi-Fi Interactive. Emily.
Well, guys, it is another ugly session across risk assets. As we can see here, the S&P 500 now down about 2.4% intraday, and the index is also setting a new low for 2022, just above that 4,000 level. If we take a look at how the index has performed for the year to date, you can see now down about 15.6%. Similar story here when we take a look at the year-to-date gains for the Nasdaq Composite, down about 25% at this point, and the Dow Jones Industrial Average performing slightly better by comparison, but still down by nearly 11% year to date and 1.6% during today's session. But again, going back to the intraday price action, do want to highlight what we're seeing in terms of volatility. The CBOE Volatility Index, or VIX, which is of course an options-based measure of expected S&P 500 volatility for the next 30 days, is spiking above that 33 level. So really above that long-run average of 20, really underscoring the volatility that we're seeing and the expected volatility going forward in these markets. Now, in terms of Treasury yields, do want to highlight the move slightly slightly to the upside that we're seeing in the 10-year T-note. Of course, when we tend to see a move higher, we do see some pressure on these technology stocks. That's exactly what we're seeing during today's session. Now, looking at some trending tickers, also during today's session, we do have Palantir is one of the big losers to the downside, down 22% intraday. That's after this company issued a disappointing forecast for revenue for the current quarter, what had just reported earlier today, seeing Rivian also under pressure, and that's after Ford reportedly is selling some of its stake in this electric trucking company. Now, if we take a look as well as what's going on more broadly in the NASDAQ 100, a lot of selling pressure that we're seeing across the technology industry overall. Apple, of course, being one of the most heavily weighed index components that's weighing on all of these stock indices. And then finally, we'll take a quick look here at what we're seeing in cryptocurrencies. Still seeing the selling action in risk assets extending here as well. And Bitcoin, if you want to see in terms of level where we're actually now at the lowest level since July 2021. So risk off day in markets extending both to the stocks as well as to cryptocurrencies, guys.
Going to potentially be looking for some magic on Wednesday. Disney reporting earnings this week. What are we looking out for there?
Well, of course, after what we saw with Netflix just a couple of weeks ago, all eyes are going to be on how Disney performed on its Disney Plus streaming net adds. That's something that investors are hoping still shows some signs of resilience, although we're likely to see a slowdown there compared to what we saw in prior quarters. Now, for Disney, Disney Plus streaming net additions are expected to come in at 4.2 million. The same period last year, Disney Plus had added 8.7 million new streaming users, and in the last quarter, we saw 11.7 million users. So certainly seeing a deceleration both on an annual and a quarter-over-quarter basis. But then, of course, Disney has both its streaming play as well as the theme parks and experiences, that reopening trade. So likely to see a little bit more of a pickup there, considering many of those virus-related restrictions had started to ease during the quarter. And the parks, experiences, and resorts segment of the business is expected to swing to an operating profit of $1.6 billion in this latest quarterly report. So we'll see how this company does overall. It has really seen quite a bit of selling pressure so far for the year to date. If we take a look, of course, it is a Dow component. If we take a look at how that company has been performing here, down about 2.2% today, down about 42% for the year to date, guys.
Good stuff, Emily McCormick. Thanks so much. Coming up, what the Doctor Strange box office numbers mean for summer releases. We'll speak with the CEO of IMAX after the break.
blockbuster summer movie season off to a magical start with Marvel's Doctor Strange and the Multiverse of Madness conjuring up the biggest opening weekend thus far in 2022. For more on this, let's bring in Yahoo Finance's Ali Canal. And Ali, maybe it's funny that it said magic, sorcery, maybe strictly speaking. I don't know. I don't know what the definitions are in the multiverse.
Yeah, whatever it is, Julie, it seems to be working because Marvel has absolutely done it again. Doctor Strange and the Multiverse of Madness opened at #1 this past weekend, grossing $185 million in its domestic debut. That's the highest domestic opening weekend of 2022 and the second biggest opening weekend of the pandemic era, right behind Spider-Man No Way Home. The film also performed very well internationally, generating an additional $265 million overseas. That brings the global haul to $450 million. And just for a little context here, estimates had placed the sequel to gross at least $160 million. The first Doctor Strange movie, which debuted in 2016, generated $85 million in its domestic debut. So on all fronts, this is a huge win and a really big boost of confidence to theater chains. There's been a lot of stops and starts amid the pandemic, a lot of bottlenecks in terms of the content, but we finally seem to be in a really good position heading into the summer. We have some really big blockbuster titles like Top Gun Maverick, the new Thor movie, once again leaning into these action-packed type films. Also some family-friendly titles like Minions and Lightyear, and these have really been the dominating genres in this post-pandemic world. These are the types of audiences that are returning to theaters right now, but I do think it's still worth noting that we're not back to quote-unquote normal in terms of foot traffic and overall theatrical attendance, and I wonder if we ever will be. That's not to say that the theater is dead. Certainly there's an appetite there, but behaviors have changed. So now that we're getting more towards a normal content slate for this summer, I'm curious how that's going to translate into the foot traffic and whether or not we're going to see those pre-pandemic numbers that are coming out. But you know, you were just talking about Disney earnings, Netflix. There's been a lot of talk of streamers potentially releasing more films in theaters. Maybe there's a way for these two mediums to work together and help each other out in the process. So I do think we're going to have a lot of answers at the end of this summer to a lot of questions that are happening right now in terms of the content world and this new age that we're operating within. But for now, this movie, Doctor Strange, a very big win for the summer.
Yeah, and it's a big win for our next guest as well. Thank you so much, Ali. Appreciate it. The debut of that movie gave IMAX its biggest May worldwide opening ever, $18 million in grosses in North America, $15 million globally. Let's bring the IMAX Corporation CEO, Richard Gelf, on. Rich, it's good to see you. I guess first up, I would just ask if this was a relief, this opening, considering its size and considering that it was sort of a test here of the early blockbuster season for the summer.
Julie, I wouldn't use the word relief, but I would say it was certainly unexpected how big it was. I mean, we always knew that this season would be really terrific. When you look at the slate going forward, we go from Doctor Strange over the next couple weeks into Top Gun Maverick, which is tracking extremely well, into Jurassic World, it's also highly anticipated, into Lightyear, into Thor, into Nope, and it goes throughout the year, which ends on Avatar, which, as you know, is the biggest movie of all time. So we did our earnings call 2 weeks ago, and we said, we've never seen this good a slate going forward, and we thought this would be the kickoff, and it was, but it certainly was a kickoff in a bigger way than we expected.
Rich, are you surprised that the economic models of the streaming giants are now being questioned by the market?
I'm not at all. As a matter of fact, I hate to beat my chest on this, but during the whole pandemic, I was one of the few people who went on a lot of media outlets, including yours, several times, and I kept saying, you know, the numbers don't work, the numbers don't work. You're selling a film traditionally across 3 or 4 windows, and you just release it in one, and it's not going to make more money. And, you know, even my good friends and my family was saying, Rich, you sure you know what you're talking about? I mean, it doesn't make any sense. But ultimately, the streaming model made no sense. The theatrical window, particularly IMAX, builds buzz around a property. It creates a cultural event on a global scale. And thinking you could do that and create that kind of excitement without a theatrical release was just silly. And as a matter of fact, one of the major streamers just told me, and this is really interesting point, that on streaming, things do better with an exclusive theatrical release. So forget about the money that you're making from the theatrical window, just on streaming, more subscribers, more retention, all things like that, because the theatrical experience really creates an event, and particularly the IMAX experience.
Going overseas, Rich, China has been a long time important market for IMAX. I believe more than 40% of your annual sales, more than 40% of the backlog for IMAX is related to China. What are you seeing in that market, and has Shanghai opened yet?
Shanghai has not opened yet, but that's about one of the few places that haven't. So if you go back about a month, I'd say around 50% of the IMAXs were open in the country. As of a few weeks ago, it was 65, and now 75% of the theaters are open in China, Shanghai being the notable exception. I mean, I think the Chinese have dealt with this in a very kind of conservative way, complete shutdowns, but the shutdowns have been very short. So places like Shenzhen we have 27 IMAXs there, had been closed, but they're all open now and people are coming back. And I think the issues in China are a short-term issue. I mean, obviously in the US, Omicron went through very quickly, as well as it did in other places. So if you're betting on tomorrow's box office, it has an impact. But I think longer term, just like in the rest of the world, it's going to resolve itself. But to relate that to Doctor Strange's box office, this was our biggest opening May ever in the over 50-year history of the company. And that did not include China. So that just gives you a sense of the magnitude of what's going on with the pent-up demand around the rest of the world.
Rich, I want to come back to something that you mentioned. You said it creates an event specifically for IMAX. And when we think about event pricing, that can fluctuate based on the type of event. When you also look across the titles that are coming forward in the theater experience and in that event that you're describing here, do you believe that we'll see more title-specific kind of pricing and that fluctuation? And what do you expect from the consumer response in those instances?
You know, theatrical experiences have pretty much been on the low end of pricing. So you look at the price of a concert, or you look at the price of a sporting event. A ticket to IMAX typically is around $15, which is a fraction of the cost of other types of events. So I think, you know, the kinds of movies that we do, which is blockbusters, and again, exhibitors play smaller movies, they play blockbusters as part of it, as well as other movies, but IMAX is pretty much a blockbuster medium. So talk about pricing where we are for this type of global event, I think it's historically been pretty low. Again, we don't set the pricing. We license our technology to the exhibitors, and the exhibitors set the pricing. And I think when they look at how that compares to other type of events to go to, there's room to increase it. And I think you'll probably see some of that during this period, particularly with the inflationary pressures.
IMAX Corporation CEO Richard Gelfond joining us here today. Appreciate it, Richard. And everyone, taking a brief look at the major averages here, we are down across the board. The Dow down 1.5%, but the NASDAQ and the S&P 500 seeing the brunt of those declines. The tech-heavy NASDAQ down 3.2%. We'll be right back.
The sell-off in stocks is remaining pretty persistent here, and indeed the stocks generally falling to new lows of the session here, with the Nasdaq off 3.3%, the S&P off 2.5%, the Dow off some 1.7%. It looks like we are not only at a 52-week low for the S&P 500, it looks like we're the lowest since last April or so, early April at that. And we've been watching the trending tickers here on the Yahoo Finance platform sort of as a reflection of the sentiment out there, heavily within tech here. Palantir lower after reporting disappointing numbers, off 20%. Rivian, on the report that Ford was selling shares, is down. Tesla's down as well, just because everything else is, I guess. And then we've got the sell-off in cryptocurrencies that is hitting Ethereum as well as Coinbase. Whew, that does it for Brian, Brad, and I on this Monday. Coming up, more of the market sell-off. Plus, we'll be live with Pros, our Pros Supermoney from Miami for the Miami Grand Prix. You don't want to miss the report on that. Stay with us.
Welcome to Yahoo Finance Live. It is 11 a.m. here in New York City. I'm Akiko Fujita. Brian Chung is off today, and we are seeing another ugly day on Wall Street to kick off the week. The Dow now down nearly 600 points. The S&P 500 down 106, hitting a new 52-week low in the session. And the Nasdaq continuing that losing streak since 2012. Today it is down more than 3%. Treasury yields also in focus today. We saw the 10-year yield hitting its highest level since November 2018, although we have seen it come down since. For more market action, let's bring in Yahoo Finance's Inez Ferre. Inez.
And Akiko, you just mentioned the NASDAQ, and let me just pull up the NASDAQ down more than 3% right now. If we take a look at a three-day chart, it's down more than 9% over the last 3 days, today, on Friday, and on Thursday. Take a look at the S&P 500 right now. That's a three-day chart, down 6% over the last 3 days, but you can see it's down more than 2% right now. We are taking a look also at WTI crude, because crude has been sliding today. It's down more than 4.5%. Accelerating losses is what we're seeing here. Looking at the sector action under the hood with equities, we are seeing energy stocks
stocks losing more than 6% right now. You've also got technology that is one of the laggards, down more than 3%. XLY, consumer discretionary, down more than 3%. All 11 sectors, though, of the S&P 500 are in the red right now. And here's the NASDAQ 100. So take a look at the left-hand side of the screen, the mega caps, the heavyweights. We're looking at Amazon, that's down more than 3%, hitting a 52-week low. You've also got Microsoft there that's down more than 3%. In fact, I'm going to put up the market cap. Look at this. Microsoft is trading below the $2 trillion level. It hasn't seen that level since June of last year. Going back to percentages, we're watching Tesla, part of consumer discretionary, down more than 7%. And you've got NVIDIA, the semis, that are lower as well. In fact, I'm going to also pull up a year-to-date chart because I just want to show you sort of the deterioration that we've seen with the NASDAQ 100. It's down 23%, a little more than that for year to date. And you can see about 50% of the components are down at least 23% or more. So you've got, in fact, right here is Tesla down 24% year to date. And then on the bottom, you have the bottom performers year to date, which are Netflix down 70%, Peloton down almost 60%, PayPal, Lucid, DocuSign down more than 50% year to date. Akiko.
Ouch. Chart says it all. Thanks so much for that, Inez. Well, as Inez said, tech companies continuing to take a big hit today, with the NASDAQ seeing its worst sell-off since the 2008 stock market crash. This comes as several heavyweights in the industry are cutting down on costs and slowing down hiring. Uber, just the latest company to do so, with CEO Dara Khosrowshahi telling staff that the company is slashing its costs and treating hiring as a, quote, privilege, according to an email obtained by CNBC. Let's bring in Paul Meeks. He is Independent Solutions Wealth Management Portfolio Manager. Paul, just give me a sense of how you're watching this. I mean, we're talking about another decline of more than 3% for the NASDAQ. How much more downside do we see?
You know, I actually think there is more downside. And so I know whenever I'm on air, folks always want me to ring the bell and, you know, give stock ideas about things that are going to outperform, you know, not just tomorrow, but this afternoon. I'm just not there yet. There are too many fundamental headwinds. And even if you get beyond the fundamental headwinds, you have some great tech companies that are doing all the right things. They've just got through a quarterly report in which they beat Wall Street expectations and gave pretty good guidance, yet their stocks are still seeing, with this macroeconomic backdrop, a valuation compression. And so if you can't even win with the good guys, I really think that it's probably still savvy to be risk off rather than risk on here.
So how do you look at this? Is it an opportunity to buy into some of these names that, to your point, have become quite inflated, but as we've seen in earnings, at least with the big tech names, the growth story is still intact. Do you get in on this opportunity now, or do you stay on the sidelines in expectation of a further pullback?
It's mostly the latter, but you're asking a dynamite question, because with select names for folks that are aggressive, not conservative investors that want to be in my tech model, and they really can tell me, not just say it, but really sincerely mean it, that they have a 1 to 2 year out investment horizon, then there are several names that I'm starting to pick away at here. But I'm not going all in. I'm not risk on. I'm not too aggressive. But I have been buying the last couple of weeks, particularly as my favorites report their earnings, if they look like they're pretty good and pretty good forecasts.
Yeah, what are some of those names you've been buying into?
So there's a couple of names I'm interested in. Arista Networks, I had a great quarter. Advanced Micro Devices, Micron Technology, one of my favorite semiconductor companies, does not report for several weeks, but I like their forecast. And then there are some ways that you can get tech exposure, at least minimally. And I don't think you have too much downside left. Companies among the FANGs, not all the FANGs, there's some I don't like, but I do like Apple, Microsoft, and Google. And then there's a couple of real defensive, high-yielding tech companies that I hated for years and years, but they're finally showing their growth. And believe it or not, after all these years of hating them, I do have some love for AT&T and IBM.
We mentioned that report from CNBC, Dara Khosrowshahi over at Uber putting out this note, talking about essentially what could amount to a hiring freeze, at least a slowing of hiring. We got that report last week from Meta, hiring freeze in some divisions there as well. I mean, it feels like we're starting to get more and more of these headlines out of these tech companies. Investors have really come to expect to only see upside. How should they be looking at that? Is that ultimately, you hate to see anybody lose their job, but is that ultimately a good thing given just how big they have become?
I think so, because in the era of low to zero interest rates, free cash flow earnings didn't matter. It was all about top line growth and some, convoluted internet-based metrics that really don't have much to do with financials. So now, with interest rates on the rise, we have to be at least some semblance of value investors, even within the tech sector. And so now these companies have to pull back on the high cost growth and doing the right thing by essentially pulling back their expenses and hopefully ushering in an era where they are generating more revenue, more earnings, and more importantly, more free cash flow by trimming their expenses.
So if you are sort of reducing your exposure in these high growth names, where do you put that money? Have you just been putting it on the sideline, or have you been investing in maybe some of the value names?
Yeah, so it's mostly on the sideline, as I mentioned, coming back with some very select names only after I hear their quarterly reports, and I'm convinced that they'll be able to weather these periods. And as I said before, on the growth side of the house, companies like Arista Networks and AMD, which I think are strong, and then to play your uber defensive, chicken tech, tech-ish, but not tech-centric, things like IBM and AT&T with their 4%, 5%, 6% dividend yields.
Paul Meeks, good to have some context here on what is yet another ugly day. Independent Solutions Wealth Management Portfolio Manager, thanks so much for joining us today. Well, coming up, Rivian is sputtering as the EV maker's post-IPO lockup period expires. The details as Ford is reportedly expected to offload some of its stake. That's coming up next. Well, the Biden administration is announcing 20 of the top internet providers have agreed to offer discounted plans to low-income households. Let's bring in Yahoo Finance contributor Kevin Cirilli as part of his weekly KC3. Kevin, good to talk to you today. Let's start with this plan. I mean, how many Americans are we talking about that could be affected?
This is going to be anywhere from 40% of qualifying Americans, or 48 million American households. And this is part, of course, of the Biden Build Back Better plan that the administration is really pushing out this week. It's for those who qualify, $30 per month toward internet servicers for eligible household. And there's, get this, 20 companies who have signed on to participate in this, including AT&T, Comcast, and Verizon. And together, when you actually add up all of the coverage zones, that's more than 80% of the U.S. population. So definitely a massive, massive step forward in terms of trying to close that digital divide.
The other story you're watching closely today, that $33 billion aid package specifically targeting Ukraine, still hasn't been passed. What's the very latest on that front?
So I think in terms, the next thing that I'm watching is Ukraine. And earlier today, Russia President Vladimir Putin spoke at his annual Victory Day speech. And so did Ukraine President Zelensky, who said, quote, that this is not a war of two armies, but a war of two world views. Meanwhile, President Biden is calling for $33 billion worth of additional funds in order to be allocated to support Ukraine. And NATO officials are back in D.C. this week, meeting with various administration officials as well as lawmakers on Capitol Hill. I spoke with one NATO official last night who told me that they are confident that the Congress will get that $33 billion worth of funding to President Biden's desk. President Biden, for his part, will be at the State Department on Friday for a series of meetings. So no doubt that support for Ukraine is still strong.
Yeah, no question. As we further drag into this war, President Biden also speaking at United Performance Metals recently, a metal manufacturer near Cincinnati. We know he's been talking a lot about more independence, less reliance on China. What's the latest on that front?
You know, this bill, the U.S. Innovation and Competitive Act, is now in conference, and it's a large conference. Dozens of Republicans and Democrats are on this in the Senate and in the House as they try to reconcile the legislation between the two chambers. But President Biden's frustration was palpable on Friday when he spoke in Cincinnati. He said, quote, pass the damn bill and send it to me. If we do, it's going to help bring down prices, bring home jobs, and power America's manufacturing comeback. This is all about that semiconductor chip shortage that he says he made the job case while he was in Ohio. And the two senators of Ohio, Senator Portman and Senator Brown, a Republican and Democrat respectively, have backed this bill. They feel it's going to create jobs, but it's also a national security component. And the administration, as well as supporters of this bill, argue that it would curtail some of the over-reliance on China on semiconductor chips. And that shortage has just really wreaked havoc on the U.S. economy and other economies, for that matter, worldwide.
Yeah, and we've already heard warnings from some CEOs who've said it's going to drag on a bit longer. Yahoo Finance contributor Kevin Cirilli, as always, thanks for joining us.
Anytime. Thank you.
Well, let's look at one of our trending tickers, shares of Rivian, moving in reverse. And we're talking big declines today, down more than 18% on a CNBC report that Ford is selling 8 million of the EV maker shares at a discount. Now, that amounts to still a small fraction of Ford's total stake in the company. The news comes after the stock lockup period expired for early investors on Sunday. Ford owns a roughly 12% stake in Rivian. The company recently reported a $3 billion hit from those shares following a big pullback in the stock since the IPO last fall. Well, coming up, accelerating to an all-electric future. Group 14 is getting supercharged with new funding led by Porsche. The battery tech company CEO joins us next to discuss why he thinks lithium silicon batteries are key to EV adoption. We'll be right back. Welcome back to Yahoo Finance Live. We are seeing stocks coming off of their session lows, but still a big sell-off here on Wall Street. The Dow down about 530 points right now. The NASDAQ, the biggest loser on the day, down more than 3% as we continue to see investors sell off some of those tech names. The NASDAQ now on its longest losing streak since 2012. The S&P 500 also hitting a new low for 2022 today, down about 101 points right now. Well, Formula One is taking a big victory lap following its inaugural Miami Grand Prix. Dutch-Belgian driver Max Verstappen took home the top prize over the weekend, giving his team, Oracle Red Bull Racing, a big win. But the biggest winner of the event may have been F1 itself. Let's bring in Yahoo Finance's Praz Subramanian, who is live in Miami. Tough assignment for you, Praz, but the fact that so many people were talking about the F1 this weekend really just points to the fact of how much growth they've seen. And some would argue you can kind of peg that to Netflix, right?
Yeah, you can. You know, really a perfect storm, right, if you will, of U.S. high interest in F1, the Miami, the glitz, the glamour here, all coming together in one big weekend. You know, we had a sellout, actually a really great track, really big build-out, nicely done around the Hard Rock Stadium, which many people were impressed by. And like you said, it's a big win for the sport, but also, you know, the brands and the people involved. You know, that Netflix effect, that is a big key part of that. And just on cue, Netflix renewed season 4 and 5 this week while we're at the Miami Grand Prix. And it's not just, you know, it's also the teams also that sell cars that are actually, that's part of their business. You know, I spoke to Aston Martin when I was here, and they told me about how, you know, on the days that they have their Aston Martin has the pace car and the medical car, when those cars are on track, they see increase on the website up 40% on those weekends. So they see actual concrete changes in their for their interest in their cars. And also they talk about how they can go to these races, especially in Miami. They see, you know, close to 200 of their clients there, and that's a big deal when you only sell 6,000 cars a year. You see 200 fans, 200 clients here, 200 clients there, 200 clients in maybe in London. And that actually adds up to a lot of value for these teams. But, you know, Akiko, it's also the big brands. You mentioned Oracle. They are a key sponsor for Red Bull. They reportedly signed a $500 million 5-year deal with Red Bull. So it's not just those big brands, it's also smaller brands like Stanley Black & Decker. You're talking about Monster Energy. You're talking about companies like AMD, a lot of big tech companies. So it's a lot of big companies that want to be a part of this race series that gets around 70 million eyeballs a weekend globally.
70 million, that is a huge audience. As F1 sees its fan base grow here in the U.S., how do you think the sport builds on the success from Miami?
You know, I think first and foremost, it's getting more eyeballs on it. You know, so right now in the U.S., you're getting about 1 million viewers a weekend for a race in the U.S. I think that in order to really move the needle, you need to get into the tens of millions, right? So I think that's the big thing that ESPN is now trying to do. They have a renegotiation with F1 to get the next season of live programming on their air. And, you know, initially when ESPN got the series, they paid nothing for it because F1 was so unpopular. F1 just wanted to have the series on in the U.S. and they said, just take it. And then eventually ESPN started paying $5 million a year for it. And now reportedly F1's like, you know what, we're doing pretty well here. Let's get $75 million. That's what they want to target. So if you think about it from an ESPN point of view, it's not that big of a deal when they're paying billions of dollars for legacy sports like basketball and football. Lots of big fans, but also those of our sports aren't growing. F1's growing. So I think from my point of view, the biggest thing for the sport to do is to get more eyeballs on it. And I think that helps at Netflix and that helps at ESPN.
Okay, well, I'll be watching. Travel back safely, Praz. Thanks so much for that. Live from Miami. Well, as electric vehicle adoption accelerates, battery technology is increasingly critical for those EV makers as they seek more power, less weight, and cheaper costs. Our next guest thinks his company could have the solution with lithium silicon battery technology, which could also prove useful solving other power problems like grid storage. Let's bring in Rick Luby. He is Group 14 CEO and co-founder. He's joining us from Woodinville, Washington today. Rick, it's good to talk to you. Let's start by sort of laying out for those who are not as familiar with the technology. How does lithium silicon battery differ from lithium ion, which is something that I think a lot more people are familiar with?
Sure. Hi, Kiko. Actually, I'm joining you today from Germany. I'm here visiting with customers and partners, following up the announcement of the investment from Porsche. But a little bit about silicon battery technology. You know, it's really a transformational technology relative to what we understand and the performance we get from lithium ion. So it's a very different chemistry on the anode part of the battery, and enables much higher energy density, so up to 50% more range in an EV, for example, and much faster charge rates. And so with a silicon battery, you could potentially completely recharge your EV in less than 10 minutes, maybe even as fast as 5 minutes.
So let's talk about that investment you announced last week, $400 million from Porsche. What do you plan to do with that money? And how significant is that when you've got a big brand like Porsche saying, look, we are in on this technology too?
We are really excited to have the validation of a company like Porsche making this lead investment in our Series C. You know, they are known for their technological leadership, as well as being just a fantastic automotive brand in general. You know, with this round, with this funding, we're now going to be able to scale up our commercial production capacity to the point where we can actually support large-scale EV programs. We have a commercial facility today in Woodinville, but that's not quite big enough to support, you know, true automotive scale. And so Porsche recognizes that silicon battery technology is in their future. They want to access our technology, and this investment is going to help us build a large-scale factory in Washington to support those needs. In fact, this factory, when it comes online, should be able to produce enough material to support an annual production of 600,000 EVs based on silicon batteries.
So, Rick, one of the big concerns with lithium silicon batteries is the swelling that happens with the charging and the battery life itself. I mean, how far are we from actually addressing that? And how rapidly would you be able to ramp up production once that's addressed?
So the industry's been trying to make silicon batteries work for at least 15 years. But you're right, because the silicon doesn't respond very well to the charge cycles, it has affected the cycle life. And so they really haven't been commercially viable. We have solved that problem with our silicon carbon composite that stabilizes the silicon, controls that swelling, and makes it last as long as a traditional lithium-ion battery.
So, Rick, you know, I wonder if you can help us understand just how rapidly the adoption is happening. You know, we often sort of see this as one technology or the other, but it sounds like the reality is, given the bold targets that are out there, whether it's in the U.S. or in Germany where you are, that you've got to have not just lithium ion, but lithium silicon kind of move in tandem. Can you talk about the sheer demand that you're looking to as we see adoption ramp up?
We're envisioning virtually the entire industry transitioning to silicon-based batteries within the next 3, 4, 5 years. You know, today we've got a commercial facility here as I mentioned, in Woodinville. The next scale facility is going to enable the kind of demand that we're envisioning from our customers, and we'll expand upon that. For example, we also have a joint venture with SK Group to establish a manufacturing factory in Korea. Provides dual sourcing, also provides more capacity. We really think that this is going to enable the entire industry to transition to silicon batteries, and certainly by the end of the decade.
What about the use of the technology in grid storage? You know, we heard last week California as well as Texas warn about constraints on their power grid as they look to temperatures rising too. I mean, that felt like a real reality check about how the transition from fossil fuels into renewables, you know, isn't quite there, but that bridge could be battery storage itself. Where do you see Group 14 playing in that space?
You know, the value proposition for silicon batteries applies to all these applications. So when you look at things like improved energy density, faster charge rates, and really lower cost, you know, from a dollars per kilowatt hour perspective, that's the value prop that everybody wants in all their energy storage applications. Silicon batteries will enable electric aviation. Silicon batteries will enable a broader deployment of grid storage. This is a fundamental transformational technology for the energy storage industry.
Rick Luby, it's good to talk to you today, Group 14 CEO and co-founder. Well, coming up, Crypto Carnage will explain why Bitcoin is hitting its lowest price since January. Next, you see it's trading just above that $32,000 handle. Also, let's take a look at where the Dow is trading right now. As we said, a big sell-off on Wall Street with the Dow now down more or nearly 600 points. We'll be right back. Well, Bitcoin is slumping to its lowest level since July of 2021 as they fall in tandem with equities. Stocks falling again to start the week. The crypto carnage is extending to Ethereum and Solana as well. Let's take a look at where those are trading right now. There you go. That's the Bitcoin chart, down more than 6%. Bigger losses for Ether and Solana as well. Joining me with the latest is Yahoo Finance's David Hollerith. David, how do we explain this? I mean, it is an ugly day across the board, but what are you seeing on the crypto side?
Yeah, well, Akiko, I think the fundamental thesis for Bitcoin and Ethereum, which is sort of it's more than 60% of the total value in crypto assets, is that they increasingly move in correlation with stocks and other risk-on assets, most notably the NASDAQ, except for the fact that they tend to trade in more exaggerated, volatile trading periods. And of course, the crypto market never closes, so you'll see trading over the weekend. Now, since following sort of the FOMC's meeting on Wednesday, cryptocurrencies saw a drop on Thursday, and that continued through the weekend. Since Thursday, we've seen about $305 billion move out of the cryptocurrency market. And during that time, we've seen Bitcoin hit its lowest point. And as I say, hit its lowest point, it's actually happened within the last hour. So investors, traders in particular, are still looking for the bottom, at least in this sort of trading cycle. And, it's obviously pretty tough to tell, because cryptocurrencies don't necessarily trade on, discounted cash flows. Technical measurements are really important for the asset class. So people are oftentimes looking at sort of these key price points for where traders might come in to buy the asset. Now, $34,000 for Bitcoin was a pretty strong point of resistance where buyers would come in. We've since hit below those levels. We're trading in the mid $32,000 range. So, I think that traders apparently have more support at the $30,000 mark. But it still remains to be seen whether or not they will come in at the same point. Obviously, the $34,000 mark has been breached. I've spoken to some institutional traders, and they've sort of pointed out that there's not like a massive flood of institutions coming in to short the market, as it were. More so, what's happening is the macro geopolitical landscape. That whole backdrop looks pretty poor right now. So a lot of institutions who have their money in crypto or did are they're essentially selling off parts of their portfolio, what you call trimming. So they're going to wait until there's a little bit more certainty, until maybe a temporary bottom is found for the asset class. But largely what I've heard is that the rest of May and June don't necessarily look good for Bitcoin and other cryptocurrencies.
Yeah, it feels like nothing's immune on a day like today. David Hollerith keeping a close watch in the crypto space for us. Thanks so much. Well, crypto's popularity certainly skyrocketed in the last several years, but now a growing number of mental health professionals are likening cryptocurrency investing to gambling and the risks associated with such addictions. One Swiss clinic is offering a recovery program for crypto addicts at a very steep price. Joining me now is the CEO of Paracelsus Recovery, Jan Gerber. Jan, my first question is how do you diagnose crypto addiction? What does that look like?
Hi, Chico. Well, it's like diagnosing any addiction. It's normally when there are signs, it's already late in the process. There can be various signs, but when people around the individual who might be addicted realize that some developments are going into a bad direction, that person might spend way too much time trading, might have apps on the phone open all the time, might get up at night to check the portfolio. Really where it takes over private life, where it creates a stress, where it has an impact on relationships. That's normally kind of the first times when normally not the person of concern, but the people around say something's not going in the right direction.
It's worth noting that you've said you specifically address the ultra high net worth. We're showing on the screen here your program is $90,000 a week. What have you heard from clients who've been coming in? I mean, it sounds like you've gotten a surge of calls from the ultra rich who, for one reason or another, feel like there is an issue here with crypto investing.
And frankly, the pure trading of cryptocurrencies and an addiction to that can happen to just about anyone. It can happen to somebody who trades with the last $100 of their savings. It can happen with multimillionaires. I believe the problem has kind of first became tangible for the addiction treatment industry or visible with the wealthy population. Was a few years back when we got the first call specifically from people who have lost millions and millions in the ups and downs of the crypto market, and then realized, particularly after losses, that this can't go on like that, and then they reach out for help. In the meantime, there are rehabs all over the world for all price segments, and to help people who got hooked.
To what extent do you think this addiction, if you want to call it that, is being fueled by some of these apps, whether it's Robinhood, Coinbase? I mean, we've heard about the concerns around the gamification of trading with those apps. Do you point the blame in that direction in some ways?
In some ways, yes. I think the problem has many layers, but at the core of cryptocurrencies, it's the sheer volatility and, to be honest, the unpredictability of the developments. It really, you can equate it from a neuropsychological perspective to gambling, online gambling. So investing in crypto, then making a windfall, even small, it creates a dopamine rush in the brain. And dopamine is as a neurotransmitter, tells our brain to repeat a certain action. This comes from the back in the days when you find a sweet berry, or you run away from a saber-toothed tiger. That basic instinct functionality in our brain kicks in when we trade crypto. And crypto is specifically dangerous compared to other things that can be traded. Other markets close. Other markets are not as volatile and are somewhat more predictable. And then, as you mentioned, those apps that make it accessible for everybody. Most of those apps are not meant for professional investors. They're meant just basically for an app provider to make money, to make some margins. We know also a lot of these apps, they're contractual differences. They're not actually the actual underlying that is being traded. And these are gamified, as you say, so they bring in additional cues. Prices might go up in the next 10 minutes. It's now your chance to place a trade. You get these notifications all the time. That hits the brain in a very specific way. So yes, that creates an additional layer of already a risky undertaking.
Finally, Jan, I'm just curious what $90,000 a week, what that program looks like. I mean, sure, these people have lost a lot of money, but they still can afford $90,000 a week. How does that recovery program look like? And is it any different from other addictions to making money, whether that's in gambling or stock trading?
The approach is very similar to a gambling addiction treatment, frankly. We have to differentiate a little bit between, is somebody coming to us, are they a professional trader? So do they have to go back there? Are they making a living with that? occupation, or can they actually take a break or stop this activity altogether? And that makes a massive difference. It's like, somebody who's dependent on alcohol. Ideally, if you can stop drinking for the rest of your life, you have a bit of an easier journey ahead than if you have to want to go back to it. And that's the same with trading. What we do primarily is we look at the underlying reasons. Some people are more prone to addiction because they've suffered from childhood trauma, or they go through a very stressful period in life. Sometimes it can be physical pain. It can be that the neurotransmitters in our brain and body are off. We have sleep problems. So often these compulsive behaviors that includes crypto trading, that create these dopamine or serotonin rushes. They used to medicate pain or distract us from problems in life. So not everybody who trades a lot of crypto is automatically at risk for addiction. So we primarily look at these underlying reasons. We treat those, and then we look at what can be healthy patterns in interacting with the crypto market. It doesn't mean you can never go back to trade, but you should need to be equipped with some tools to do so healthily.
Yeah, fascinating to see the growth in that. Paracelsus Recovery CEO Jan Gerber, appreciate the time today. Thanks so much for joining us today. Well, coming up, combating cyber crimes amid a talent shortage. A Microsoft executive joins us next to explain how bad actors are creating a ransomware gig economy and what tech companies can do to fight it. That's up ahead. Welcome back to Yahoo Finance Live. We are continuing to see a sell-off on Wall Street with the Dow down 520 points, the S&P 500 down roughly 100, and the NASDAQ down more than 3% there, with those tech names continuing to sell off. Energy also sinking. We've seen that sector down more than 6% there. A lot of that coming on the back of the commodity moves we've seen, with oil down 6% as well. It's still the best performing sector this year, though, and the only sector in the green. We're talking about energy, of course, up about 40% in 2022. Well, cybersecurity remains one of the top threats to the country. And with 2.5 million open jobs in the field of cyber defense, Microsoft wants their customers to be prepared for everything. The company is launching its latest service, the Microsoft Security Experts, today to help clients navigate evolving cyber threats. Let's bring in Vasu Jakal, Microsoft Corporate Vice President of Security, Compliance, Identity Management Business. Good to talk to you today. Talk to me about this service.
Hi, Akiko. It's great to be here with you. Thank you so much for having us. Before I get to the service, let me talk about the two driving forces that have really helped us shape this. And you talked to it before. The first one is the incredibly complex and frequent threat landscape that we're seeing. Customers are dealing with this frequency, this sophistication in cybercrime, whether it's across nation state or ransomware today. In fact, Microsoft Security is tracking more than 35 ransomware groups and 215 unique threat actors across the board. Then you take that and you augment that with the skills gap and the incredible talent shortage that we're seeing today. Nearly 1 in every 3 jobs, Akiko, in the US in cybersecurity is unfulfilled. We have 2.5 million security jobs that are currently vacant. And all this is causing millions and trillions of dollars of cybercrime impact. In fact, cybercrime is predicted to cost the world $10.5 trillion annually by 2025, up from $3 trillion just a decade ago. So given these two driving forces, our customers and organizations across the world, no matter who you are contending with a lot. And we know that technology is a must, and technology alone is not enough. So with that in mind, we are delighted and thrilled to announce Microsoft Security Services, a new category that we are launching, which brings together expert-developed and expert-trained technology with really these human-led services, humans who are on the front lines, in the trenches of security, coupled with all of the threat intelligence. We see 24 trillion signals a day.
Yeah, I mean,
so
what specifically does that mean? Sort of moving away from corporate speak, what does it mean for clients who are saying, look, we know the threats are there, but we just can't get out ahead fast enough? What does this specific service launch today mean?
Yeah, what this specific launch means is if you have technology, so let's say you are using Microsoft technology in your security organizations, we now provide humans come with the technology. And there are 3 types of managed services, which is technology plus humans. The first one is called hunting. And what this means, Akiko, is if you are looking at threats and you're trying to decipher them, then along with the security experts in your team, you have Microsoft experts who work side by side with you to decipher and find these threats. The second one is what we call defender experts for XDR, extended detection response. This is related to threats come from anywhere, not just your devices, but through your identities, your emails, your cloud apps. And again, these humans will work side by side with you, not just to detect, but also to respond to these threats across the spectrum. And then the third one is if you need the whole gamut, a comprehensive expert-led services called Microsoft Security Experts for Enterprise, which combines threat intelligence and these XDR services.
Finally, Vasu, you talked about the shortage of workers in this space, and I wonder why that's the case. I mean, how much of this is about the threat just moving too quickly for companies to be able to respond? How much of this is about a lack of training in the skills that are necessary to deal with the cybersecurity issues that so many companies are facing today?
It's a combination of 2 things. A, the threat landscape is advancing really, really quickly. And so to keep up with that, to your point, you need to train the people who are in security. And the second one is we need to also embrace a more diverse workforce, and we need to find new people because attackers come from everywhere. They represent the world, and our defender workforce needs to meet them where they are at, and we need to reflect our words. So we do need more people, Kiko, in the security workforce today.
Yeah, and that points to why you've seen so much growth in the security space from Microsoft. Vasu Jakal, Microsoft CVP of Security. Appreciate the time today. Thanks so much for joining us.
Thank you, Kiko.
We are off for another break, but let's take a quick look at the markets. As we've seen, it's pretty much red across the board today, with the Dow now coming off of the lows, down about 500 points. Oil, one that we've been watching closely because it is down more than 5% in the session as investors dissect EU talks about slashing Russian supplies. You see Brent crude there at 107 a barrel, WTI crude futures at 104. We'll be right back. Well, stocks coming off of the session lows, but we're still talking about a decline of 1.5% roughly for the Dow. The Nasdaq, the biggest loser on the day, down about 3% right now. Tech and energy, the biggest laggards so far, with energy down more than 6% when we're talking about the sector. Let's bring in Yahoo Finance's Emily McCormick, who is tracking all of the market action today. Emily.
Well, Kiko, the selling pressure is really not letting up today on Wall Street. As we can see here, the S&P 500, it had closed its fifth consecutive weekly loss just last week, and now we're heading for a sixth potential weekly loss if this selling continues here. This index down about 2.2% intraday. The Nasdaq Composite, of course, the big laggard here, down 3% intraday, and the Dow Jones Industrial Average, the best performer by comparison, but still down by nearly 1.5%. And if we take a look at where things have now trended for the S&P 500 on a year-to-date basis, we are now hitting the lows of 2022 so far here for this blue chip index, and volatility is really the name of the game here. We can see that clearly in the CBOE volatility index, or VIX, which is of course a measure of the expected 30-day volatility for the S&P 500. That index climbing to nearly 35 here intraday, and of course that longer run average is right around 20, so we are well above that average level here. Now, in terms of what we're seeing in the bond market, Treasury yields, at least on the long end of the curve, are moving a little bit lower intraday today. They've been fluctuating between mild gains and losses, but over the past month, it has clearly been on an uptrend. That 10-year T-note yield up by nearly 14% on a one-month basis. Then just highlighting a couple of individual names that are making some major moves in markets. Of course, there's a lot of red across the screen here as well. Palantir being one of them. This company just issued weaker than expected guidance on revenue in its results that it posted earlier today. And Rivian, of course, moving lower after there were some reports that Ford was selling some of its stake in this electric vehicle maker. Then broadening out to see just what's going on in some of these major technology stocks. A lot of selling pressure that's happening in the mega cap tech names, Apple, Amazon being two notable examples. Those are, of course, heavily weighted index components as well. That's really leading these major indices in the red here. And again, a lot of red across the board when it comes to the sector action. Consumer staples, the one exception today, Akiko.
We've also seen rapid declines for crypto. I'm looking at Bitcoin trading just above that $32,000 level. What are we seeing in terms of crypto-linked stocks?
Well, taking a look quickly just at the cryptocurrency price action to begin with here, we've seen a lot of pressure for Bitcoin, for the major cryptocurrencies over the past several days, and that's really coming to a head today. We can see Bitcoin is down another 6%. You'd have to go all the way back to July 2021. That is the lowest level that Bitcoin is now trading at, down about 44% now over this one-year period. And when it comes to crypto-linked stocks, naturally, when we see cryptocurrencies under pressure, these crypto-linked stocks such as Coinbase, for example, even PayPal, of course, which just recently reported results, in Square, also really seeing quite a bit of selling action as well. Now, Coinbase is slated to report its quarterly results tomorrow afternoon, so we'll see how this company performs then. But just based on what we're seeing in the cryptocurrency price action, investors not really showing a whole lot of optimism here for these names, Akiko.
Yeah, hard to find optimism anywhere. Emily, thanks so much for that. That does it for me on this Monday. Keep it right here on Yahoo Finance. We're going to continue to track this Wall Street sell-off.
Shares are on the move following its latest earnings report. The auto technology player reiterated its full-year sales guidance as it looks ahead to keep partnerships with companies like Nissan and Mercedes. We're joined now by Luminar founder and CEO Austin Russell. Austin, always great to see you here. Let's talk production. Are you still on track with your production for your products?
I think one thing that we outlined at the beginning of the year that was great was these 4 key business milestones that we had to be able to track the progress throughout the year. So everything from Iris industrialization for series production to software, commercial programs, our forward-looking order book, and we're on track to meet or beat each of those 4 key milestones, as well as the overall financial guidance that we gave at the beginning of the year for everything that we set out. So we're really all in to make this happen. We're just hot off the heels of establishing this new partnership with Nissan as well. Which is very excited to be able to have that aligned vision, and really the first time this kind of technology being able to make its way to a mass market automaker. So it's great to be able to see that happen. They have a vision to be able to ultimately see this kind of technology standardized on virtually every vehicle they produce by 2030. So I think the signs are there, and it's really coming together and continue to happen. See, you got a cool graphic up with some of the other partners that we have as well. So we're focused heads down in execution like no tomorrow, and it's enabling us to actually now even what we're doing now is we're actually going to be even increasing our series production capacity planning and some of the work that we're doing to be able to make sure that we can have that expanded capacity from just increased volume indications, everything that we have. So obviously it's a tough market, but with everything with Luminar and everything we got going on, it's as great as it could be. I mean, I've never had greater conviction for us in the company.
Hey, Austin, we pull out all the stops from you. This ain't no bucket shop, my man. But look, let me follow up this. So you mentioned something. You mentioned something that caught my attention on the earnings call. I want to make sure I have it right. Did I get it right that you are not receiving compensation until your stock price reaches $50 a share?
That is correct. That's 100% there. That's how much conviction I have. We're truly putting our money where the mouth is, so to say.
So you're not getting a salary. You're not getting a salary.
Nope. For going any normal CEO salary, pay package, whatever it is, in favor of this, which would kick in at $50 per share.
Forgive me, Austin. What are you living on? Sorry.
I'm doing okay.
Okay. We won't delve too deeply in that. Speaking of which, your stock is down again today following these results, right? And it looks like that the street is focused on the revenue miss in particular. What do you think happened there? Do you think it was a question of maybe you could have managed expectations a little bit better, or were there some unexpected things that cropped up in the quarter?
So I think we don't give quarterly guidance as part of all of this. So all the numbers that we have are actually ahead of all the internal expectations. We only give annual guidance because trying to pinpoint things down to cents level on a quarterly basis there too is probably not a great exercise for us at this stage. We probably will at some point there, but when it comes down to it, this is where obviously it's I think it was one of the worst days for tech companies in quite a long time with this. And, we've talked before, I think, getting dragged down with the SPAC pack that was there. But in a world of companies that overpromise and underdeliver, we want to be the company and we are hopefully being able to take the right steps to prove the track record of being the company that will underpromise and overdeliver. And that'll be absolutely critical, we think, to being able to build out this company and to be able to realize the amount of value that's there. So I think so you can speak to the conviction that's there, but I think it's fair to say that obviously you believe it's substantially undervalued at this stage, and probably some misperception there. So I think it's also fair to say that we're going to be buying back a heck of a lot more stock at this point here too at these levels. It's better for us.
How much stock do you think you'll be buying back?
Our own.
What's that?
He doesn't know. I think it's what.
Oh yeah, so I was saying for in terms of buying back, we'll be buying back our own stock as part of this. So we actually had something that we announced at the end of last year as part of a convertible transaction that would be able to enable us to repurchase as much as $300 million worth of stock as part of this. And I think we've been doing that, and we're going to continue actually doing more. Particularly, it makes it obviously very attractive at these levels.
Austin, I may need a car within the next year and a half, 2 years, and I'm eyeing a Mercedes. I've been working hard the past decade. When might I see your technology in a Mercedes?
So when it comes to vehicles, I think you're ultimately going to have to ask the OEM for the specific details on their launch timelines for all of the everything that goes into it. But I think it's fair to say that when it comes to this kind of tech being realized on vehicles in series production into consumers' hands, and being able to be launched with this. This is not something that's a long-term trajectory anymore. This is something that's starting to be measured in months rather than years. And so this is something that we couldn't be more excited about, to be able to see through the initial launch of this with Iris. And as you can see, the programs keep piling on and piling on and piling on. We're now working with as noted, the majority of major automakers, from at some stage of development or even series production for this. So, but really look forward to the introduction of the first capability of its kind out of consumer vehicles into consumers' hands in the relatively near future.
Long-term goal, $100 bill of materials target. What does that timeline look like?
Yeah, so the timeline for that, I mean, this is what we outlined as kind of a multi-year type journey for this, of when you really get into the millions of units quantity and scale for this. And that's something that we actually now, with that, we recently acquired this company, Freedom Photonics, which was the last pillar of all these core LiDAR components. So we own the laser, the receiver, the processing electronics, everything across the board from the chip level up as part of these core and proprietary designs that we have. And this vertical integration allows us to be able to, I mean, it's really three things. Obviously, one of them is the cost side of things. It can enable us to hit that $100 bill of materials. But there's also widens the competitive moat and enables us to secure capacity for greater scale and ability to have our control over the roadmap, and actually even accelerates the roadmap to that extent. So all of those things are a benefit, but we ultimately don't need to hit the $100 bill of material to have a great business as part of it, but it certainly doesn't hurt to be able to drive those costs down sooner than later to be able to get even more margins.
Well, you put it out there. You got to do it now, Austin, obviously. So we'll continue to track the business.
We're making it happen. We're making it happen.
Thanks so much for the time here and breaking down some of the results for us, Austin. And yeah, we hope you get to that $50 per share price, because ultimately that looks pretty good for you and for the investors too. Austin Russell, Luminar founder, CEO, joining us here.
We want to get back to those jobs numbers now, and that 428,000 climb in jobs added to the U.S. economy last month. Let's welcome in Marty Walsh, U.S. Labor Secretary. Mr. Secretary, thank you so much for being here. As we've been talking about, broadly a strong report. So forgive me, I'm going to pick on one of the things that was not quite as strong, and that is the labor force participation rate at 62.2%. As we saw people drop out of their workforce, our Brian Chung was telling us earlier, most of the folks who dropped out, the majority of them were men. Do we know what exactly is going on there, and how are you all viewing this still anemic participation rate?
No, so thank you. So the report was good. I'm very happy. Let me start with a positive. The participation rate, certainly, it's the first time in over a year, I believe, that we saw a dip there. But we do have to take a deeper look into the numbers to see exactly what's happening. I don't have a quick answer this morning for you, other than, I think our work and the president's work on getting our economy back. We have 95% of the people that were not out of work pre-pandemic or during the pandemic are back to work. But what we want to do is take a more granular look at that number to see if there's regions in the country that number's higher, and try and honestly get to the bottom of it. I think part of it could be skilling up, people leaving jobs and not going back into finding other jobs for whatever reason. Maybe they don't have the ability, the skills, the training to do with those jobs. So I think there's a space for us here at the Department of Labor to jump into that area and make some real big gains. And overall participation rate, we want to, I think it's really important for us to see those numbers get higher and more people participating in our workforce, because there are many jobs open and there's still a decent amount of people out of work.
Secretary, to what extent do you believe that the participation in the labor force will also kind of subside some of the concerns around the supply chain, which we know is leading to some of the larger inflationary concerns?
Well, I think when you think about supply chain, I was out in the Port of LA last week. I met with some of the port officials, and they were talking to me about the stresses on the port. They were telling me that there were 27 ships offshore waiting to come into the harbor. A month before that, there were 67 ships. So we're seeing some of those supply chain issues ease a bit. There's still going to be a demand out there. Obviously, China shutting down most of its manufacturing is going to be concerning. It's concerning to me because we have 100 ships, roughly, I think the last time I heard, 100 ships in China waiting to be loaded up and be brought to the United States and other parts of the world. So I do get concerned about that. I'm not concerned necessarily about workforce at the ports, but I do think that supply chain issues have definitely added to inflationary problems, and what we don't want to see, we don't want to exacerbate that over the course of the spring and the fall, summer and the fall.
Mr. Secretary, this week we heard from billionaire Starbucks CEO Howard Schultz, and he said he's going to be investing more in training and wages for those parts of the Starbucks workforce that are not part of the labor union. Now, as a champion of the labor movement, how does that make you feel?
Well, I think he's going to have to invest in all of his workforce. I don't think he can just invest in the people, the dozen shops that organize. It just doesn't seem like a good business model. And I think that by investing in employees, I commend him for that. I commend him for investing in their salaries. And I also would recommend that the stores that organize to sit down and have conversation with them. I think by ignoring them or not having conversations doesn't solve any problems. And I think that there can be a real partnership here to help continue making Starbucks a very successful company.
And we also know that you met with some of the Amazon labor organizers yesterday, along with the president. I'm curious, Mr. Secretary, what do you think has been driving this latest labor push at a time when we are seeing rising wages in the United States and we are seeing a robust job market?
Well, we met with 6 individuals yesterday that organized 6 different companies. And really, when we talked to them at the table, most of them, a couple of them were talking about the treatment of employees in their spaces, if you will. And there is definitely a drive here in this country and an excitement and a new energy in people looking at organized labor as an opportunity for better working conditions, better salaries, better benefits. We're seeing that all across America. I think the number is 57% of people are looking at organizing their workplace. And I think, quite honestly, there's a conversation going on. Just like all the economy, we could talk about inflation, we could talk about supply chain, we could talk about wages, but we can also talk about workers and where they're at. And workers are looking to position themselves in a better future for themselves and their family by increasing their wages and benefits and work conditions.
How much do you believe that the U.S. is going to need to spend in order to upskill for the future of work and the positions that are going to be opening up in the future?
Well, I think we have to make real investment in job training, workforce development. I'll give you an example. I was in Oklahoma the other day. I was at Tinker Air Force Base. It needs, I think they told me, 3,000 electrical engineers to be able to handle the work that's right there in front of them. About 1,500 of those electrical engineers come from the schools in the surrounding areas. And I think when you think of tech companies and biotech companies in manufacturing and advanced manufacturing, we need to do a better job as a nation educating our young people and creating opportunities and pathways into those jobs. And I think that for every dollar spent in job training, workforce development, it's a really smart dollar to spend. I saw it when I was mayor of Boston. I saw it when I was in the legislature in Massachusetts, and certainly see it at the Secretary of Labor. There's lots of opportunities for us to help people upskill their ability, or not upskill them, but give them the education they need for good paying jobs in this country that are open right now.
Mr. Secretary, we hear you're going to be a grandfather this summer. Our congratulations.
Yeah, thank you. Very excited.
All right, we'll talk to you soon. U.S. Labor Secretary Marty Walsh. We'll talk to you soon.
Well, it has been a good 24 hours for collectible toy maker Funko. You see the shares of the company up 21% in the session. It's been jumping on news of a $263 million investment from a consortium of investors, including former Disney CEO Bob Iger. Joining us now in an exclusive interview is Funko CEO Andrew Perlmutter. We've also got our very own Brian Sazi here joining me at the desk. Huge news. Talk to me about how this came through, because it does, I think, really open up, at least, I was thinking about this yesterday, about how it opens up the opportunities for the company when you've got somebody like Bob Iger on board.
Yeah, thank you for having me on. We are thrilled with this new partnership. They've had interest in Funko for quite some time. Timing never worked out. It seems like timing is perfect now, and you're right. The partnerships and the network that they bring to the table in a lot of the areas that we're looking to focus on, whether it be sports or tech, or entertainment, there are so many different exciting opportunities that this partnership will bring to bear that will just help us accelerate the brand growth, globally. We're thrilled with this. We couldn't be more excited to dive right in.
Andrew, a source told me that this move with the raising the capital and investment removes an overhang to your company. What do you think that overhang was, and what were you hearing from investors?
Yeah, so we had a wonderful long-term investor with Acon, who was with us for the last 7 years. And as you know, after a period of time, PE firms need to diversify, and that time had come, and I think that's the overhang that you're referring to. And so this was a really well-timed transaction that allowed for somebody to get in and help us grow this company to the next level with some really good strategic partnerships. And it also allowed Acon to move on from their investment, which they had stated they were going to be doing.
I don't have to tell you this, Andrew. This is a large slug of money. Where specifically do you plan to use it?
Yeah, so I think that, when we take a look at our opportunities, we've talked about, the areas that we want to focus on, right? We're continuing to build our D2C infrastructure globally. We started in the US and we've moved into Europe. There's still a lot of opportunities globally. We have not maximized the U.S. or Europe yet, not to mention the other countries around the world where our brand growth is significant. And so we believe we're going to need to invest in there. We've done a lot of infrastructure investment this year on the core business. And we think that one of our growth pillars is maximizing that core, which is always at the heart of what we do. International growth. We think that there are opportunities to expand the business, similarly to how we did in Europe when we bought our distributor in London and took that business direct, and now that's our second largest international growth territory. So we think that international growth is huge, and then there's diversification of revenue. That's really important to us. You've seen us do that over the years, whether it be through Loungefly, which is our fastest growing brand in Europe. Very exciting. If you walk through Disneyland, you'll see that every third or fourth person that you see is wearing a Loungefly backpack. That's indicative of that company's brand and the power of that brand. We acquired a game studio, Forest and Brazon Creative. We're now a go-to board game company in the industry. We launched collectible gaming platforms to connect the collector and the gamer where they intersect. And we're really excited about that first launch with Marvel Battle World, and there's a lot more on the way. So, I think that focusing our energy on our avenues of growth and accelerating some of those areas, whether it be D2C or digital, we just had our largest ever NFT drop yesterday with a DC Comics drop with our newest partner, Warner Brothers. We had close to 500,000 people ready to buy that from Funko. That's the most we've ever had. We're super excited about that. And we think that this partnership could only help accelerate that.
And Andrew, you talk about NFTs. I mean, that's where I want to go here. You had already 63% increase in net sales over the quarter, which you just reported. But how much of a windfall do you think that NFT business is going to give you? We've heard some anecdotes just over the last week about whether or not the NFT market has kind of peaked here. I mean, how profitable, how lucrative do you think that business is for you?
Yeah, we read the same article and we were scratching our head because we're not experiencing what that article was highlighting. We actually think that there's a couple of reasons why. Number one, our approach to the NFT market is different than others. We are focusing on what we do best, which is, accessible price points for a wide range of consumers. That's how Funko grew to be what it is today. Everyone's a fan of something, so we have something for every fan. We're approaching the NFT business in the same way. We are not going with, really large price points. We're going with accessible price points, and we're connecting the physical products with the digital products, meaning that you have an opportunity to win a physical Funko Pop. Nobody else, to my knowledge, is doing that. And it's core to who we are and our brand. And we're starting to see that pay off because our core fans are now getting into the digital NFT business, as well as people who are into that digital NFT business who aren't maybe Funko fans. We just started our first physical product redemption cycle for Teenage Mutant Ninja Turtles, and I believe Iron Maiden. And if you go on to the secondary market, you see people are excited that they're getting those, that they're starting to get the physical products. And our fans are saying, hey, I want in on that, right? And we're very excited about that. So we're not experiencing what you're referencing. We're only experiencing growth. And so we're really excited about the opportunities that it brings.
Andrew, I brought in, can you see this? My favorite Funko in honor of our interview today. It's my favorite. It's one of the few ones I own. LeBron.
This is life scale too, by the way. This is actually.
But it got me thinking yesterday that you've got big names like Bob Iger, the Chernin Group on board. You look at the Chernin Group, for example, they invested in a card game that then tied with Netflix for an animated content. And I wonder if that's kind of how you see things moving. And I guess for my sake, could we see an animated LeBron?
Yeah, I think that you really hit the nail on the head there. Rich Paul is part of the consortium that's investing in Funko. Obviously he's got a pretty substantial relationship with LeBron. So those are the type of connections that this new partnership with the Chernin Group brings to bear, whether they be deepening our relationships in the sporting, in the world of sports or music, or there's a lot of different opportunities within the entertainment. How do we take the Funko brand and IP to the next level? And we think that there's a lot of different opportunities, which you just hit on the head. And these are exciting opportunities that lie ahead that we're going to be exploring, with our partners.
All right, Funko CEO Andrew Perlmutter, and we've got our own Funko LeBron James here on set as well. Brian Sozzi, thanks again for that conversation. Appreciate it.
Let's just get to our guests here. We've got David Schwarzbach. He is Yelp CFO. He's joining us today. And I wanted to point to the stock that move that we're seeing today. I mean, obviously, when you look at the quarter, you had record quarterly revenue, but we saw a dip in the stock. I wonder what you think investors are missing from the story.
Well, coming off of a great 2021 for us, we continued to deliver in the first quarter. We were up 19%. It did reflect a rebound in our restaurant, retail, and other categories. That grew 27%. Yelp's really known for restaurants, but actually about 60% of our revenue comes from services. That grew 14%. Now, we think that there was real demand for advertising in the first quarter. That's what we saw as advertisers wanted to reach consumers. We think that we're very well positioned to deliver against that. And what you asked, what are investors missing? We've really gone through a strategic transformation over the course of the past 3 years, and we think the first quarter really reflects the progress that we've made.
And David, I want to dive a bit more into that ad revenue. Of course, you said that really drove growth this past quarter, but businesses can opt for either a free page on Yelp or they can use ads to help promote their business. What do you think? We were just talking about the jobs report out today. What do you think this says about the overall state of small businesses that are on Yelp's platform?
Well, what we are seeing is that small businesses are seeing folks coming back out. People do want to get back out, notwithstanding the fact that we're not past COVID yet. And so they want to reach those consumers. That being said, if they can't hire enough people to staff, then they don't want to spend too much on advertising and drive even more people in. All that being said, what we see on the services side is significant demand because people are still at home and they're still doing those projects that they've put off for a little bit of time. Overall, we think that our consumers are looking for ways to address inflation. As you know, Yelp is very well known for the reviews, and people want to make great decisions, especially when things are more expensive, and we think we really help them to do that.
Hey, David, it's Brian Chung here. And what's interesting about Yelp within the context of this inflationary story is the ability of users to filter by 1 or 2 or 3 or 4 dollar signs. And what was interesting was that your data team actually had a report that noted that people who are going out are indeed looking for perhaps more expensive restaurants. Is that because restaurants are getting more expensive and they're actually changing their rating online, or is it because just the types of occasions that people are looking to go out to eat or go out to services is changing in this environment?
We do think it's a combination of both of those things. So restaurants are more expensive today. And so you really are being more selective about when you're going out. We think people still want to get out again after COVID, and they want to make that a special moment for themselves. And then maybe most importantly, as people go out, they're really maybe, because things are more expensive, not able to go out as frequently. So they want to make a great decision there as well.
And David, also too, on the site, there's also options for customers to be able to see what exactly amenities that they offer. In that report that Brian was referencing, you're also seeing consumers look for EV or perhaps sustainable options. What sort of demand are you seeing in that regard of these type of amenities?
So we do have many different badges, including those. And our purpose is really to provide folks with the information they're seeking in order to make that decision. And so people do want to go out and they want to go to restaurants that are green, or they may be vegan, or they may be a Black-owned business, and they want to support those businesses. So we think we play a critical role in enabling businesses to really tell their story. And when consumers are looking for them, they find them on Yelp.
And finally, David, I wonder if you can speak to the health of the businesses that are on your platform. You were talking about consumer behavior, not necessarily pulling back just yet. There's occasions where people still want to go out and eat at a nice restaurant. But so many of these businesses have really been struggling over the last few years. And I know you saw a drop off after the pandemic to those businesses that decided to shut down. What's your sense, based on what you're seeing right now, about how much of those businesses have returned?
Yeah, so we're seeing actually significant we're seeing significant business creation over the course of the pandemic. I think we're all a bit surprised by that. And really, the businesses that have been able to make it through COVID are stronger. What we saw in the first quarter was significant advertiser demand. We saw that across categories. We saw that in our restaurant, retail, and other categories. We saw that in our services business. And we were really pleased with our ability to deliver the quarter against this complex macro environment. And we're very, very happy with the progress that we've made. And certainly we want to continue to deliver value to advertisers and consumers alike.
Yelp CFO David Schwarzbach, it's good to talk to you today. Really a perfect conversation on this Jobs Day. Appreciate the time, and our thanks to Brooke DePalma as well for joining in on the conversation.
Let's head over to our markets guest now for more analysis. Let's bring in Nancy Tengler, Laffer Tengler Investments CEO and Chief Investment Officer. So Nancy, as we try and make sense of what happened between the Fed's announcement and this continued sell-off that we're seeing, how much of this are signals that investors are actually looking at versus noise in the market?
Well, thank you so much for having me, Rochelle. I think the Fed's presser was disappointing. It lacked urgency. It lacked the credibility of a Fed chair who's going to do something about inflation. We've heard him say he's going to be nimble and humble, and yet he very quickly ruled out a 75 basis point hike, which may indeed be what's needed. And so the bond market has taken over. In fact, we've only seen 75 basis points in hikes so far, but if you look at the 2-year and the 10-year, the movement has been pretty dramatic, as well as in the 3-month. But the market is basically forecasting stagflation. The long end is yields are rising, and that tells you that the market thinks growth is going to be slow, or that this Fed is going to make a mistake and topple us into recession. So I was disappointed. I thought the rally was premature, to be sure, and I think we have a little more work to do here with stocks before we can declare a bottom.
And Nancy, I wanted to ask you about that. You're saying that we have a little bit more work to do until we get to that bottom. How long, I guess, when you take a look out, is this going to be something that occurs over the next couple of weeks? Are we talking the next couple of months? How do you see that timeline?
So there's some historical guides, Shauna. I mean, you can look back at other midterm election years, and we're kind of right on track. I mean, market usually sells off into the first 3 quarters of the year and then rallies in the back half. But now you've got all these other factors to take into account. We've got high inflation, and you can only go as far as the Atlanta Fed and look at the sticky inflation numbers at about 4.5%. So that's going to take some time to work through the system. The other side of that argument, however, is that corporate earnings, the companies that we own, have actually had quite a good quarter. I'm hearing a lot of analysts talk about bad earnings in the first quarter, but they were up 10%. Companies actually raised their guidance. And for us, a really important indicator is our management's raising the dividends, and they're raising them quite a bit. So usually managements won't do that unless they think long-term sustainable earnings power is sustainable. So I think watch for earnings revisions. We will get them because the purchasing manager indexes have rolled over, and so we know that we already knew we were slowing in terms of growth. So you want to own the reliable growers, the companies that aren't tied to the cyclicality of the economy. You want to own dividend growers, and I think you'll get through this just fine, and then you'll look great coming out the other side.
So for the earnings that have already come out, which ones do you like, and how should people be thinking about this in terms of a strategy?
So I think you hear that technology stocks are tied directly to interest rates. So if rates go up, technology stocks go down. But that is true of the companies that don't earn, that have a lot of debt on their balance sheet. But you look at a report like the one that came out from Microsoft. They beat on every metric. They raised guidance. The company is in the sweet spot of where our economy is going, the fourth industrial revolution, if you will. Cloud drives that, and they're a big player in the cloud, and they've been growing very quickly. So I think you use the across the board pummeling of tech to pick off a name like Microsoft. ServiceNow is also a cloud data director on the cloud, and that company beat on every level. And the CFO started the call by saying, our product is deflationary. I mean, if we have a labor shortage, and it appears we do, the participation numbers were pretty pathetic this morning. If we do indeed have that, companies are going to do more with less by investing in tech CapEx. And indeed, we've seen that. Tech CapEx is now exceeding old economy CapEx. It's well above 50%. So I think you want to be clear-eyed and have a reasonable time horizon of 3 to 5 years, and use this as an opportunity to buy companies like that.
Nancy, we know at a time like this that the consumer is so important. The consumer has been powering the economic growth that we had been seeing most recently. But when you take a look at the fundamentals right now, are the fundamentals for the consumer still strong?
They kind of are. I mean, certainly real disposable income is negative. I mean, we've been getting raises, but prices are going up. But there's still $2 trillion in excess savings over pre-pandemic levels that the consumer has to work with. I mean, I'm in Scottsdale, You can't get a restaurant reservation without booking a month ahead of time at any of the sort of reasonably high end or nice restaurants, and it's busy and hopping. And I think there is a lot of activity that outside of the Beltway and outside of Wall Street that investors aren't necessarily paying attention to. Travel and entertainment. It's hard to get a hotel room. I had to make a change on a hotel room in New York, and they upcharged me because they didn't have a lot of rooms. So I do think that individuals are going to get out, they're going to spend. It's just going to be different spending, and I think they're moving away from goods and more towards services, and that's okay too, because that's an important segment of the economy.
And I want to talk layoffs here, because you noted that we saw with mortgage companies and Netflix and Robinhood. We also see now that Facebook is going to have a hiring freeze. What impact do you expect that to have?
I think eventually, Rochelle, that could be problematic because, right now, what we could say with confidence is you don't get a recession without weakness in the labor market. We've got those 11.5 million JOLTS jobs outstanding, got 6 million people looking for work, but we are starting to see the nascent signs of layoffs, of slowdowns in hiring, and that will accelerate as confidence, small business confidence goes down. I mean, the numbers yesterday were troubling. The productivity and unit labor cost numbers, those bothered me more than anything that I've seen in the last couple of weeks, because that tells us that small businesses are not getting, and any business for that matter, are not getting the productivity that they need to get out of their workers. Now, they're volatile in the short term, but the ULC is up around 8%, a problem.
Nancy, real quick, what do you make of the bond market? Because lots of talk about the 10 years moves recently, obviously above 3%, so well above a 3% today. How much higher do you see yields going?
That's the question, Shauna. We said in August of 2020 that bonds were riskier than stocks. And since that time, the TLT, which is the 20-year ETF, is down 31%. And even with the rout we had yesterday, stocks are up 29%. So I think from an investing standpoint, I think it's still too early to start nudging into bonds. We've been looking and kind of licking our chops, but I think you want to let this settle out. And even if you get, miss a few ticks on the way down, that's still going to be a much better entry point than earlier this year or in August when the 10-year was at 50 basis points. I wouldn't rush, because at the end of the day, you're just going to get your coupon payment if you hold to maturity, whereas at least with stocks, you're getting a growing income stream paying you to wait while the market settles down and gathers itself up for the next rally.
Nancy Tengler, always great to get your perspective. Laffer Tengler, Investments CEO and CIO.
Fubo TV's Q1 data came out yesterday, and the stock down today more than 20%. Well, to unpack that earnings report as well as the road ahead for the company, I'm joined by Fubo TV co-founder and CEO David Gandler. David, good to see you there. So, as we saw with those first quarter, an earnings per share miss, revenue in line with expectations, and it did more than double from a year ago. Talk about some of the biggest headwinds and drivers this past quarter.
Yeah, so we had I would say, a relatively strong quarter with 98% revenue growth, 81% growth in our advertising business. In terms of headwinds, it's just a tough macro environment, as you already know. You've seen some capitulation over the last couple of days, which I think has really led to an aggressive situation with respect to many of the growth stocks. But for us, really, it comes down to hiring more people and continuing to execute on our plan.
Now, I want to talk about the North American market. There was some forward guidance that saw a decline in subscribers and revenue, but as you mentioned, they're consistent with some of this normal seasonal trends that you're seeing in business. Where do you see the opportunities within North America and outside of it?
Yeah, so the North American market is extremely strong. What we continue to see is that the macro trend around the secular decline of television continues. There are still an enormous number of households, roughly 72 million households that still have cable. And particularly as you go into a recessionary period, I think people will typically look for lower cost alternatives. And alternatives like Fubo allow you to maintain your current lifestyle, reduce costs. So we're very, very bullish on the business of aggregation in general in terms of cable bundles. So excited there. The advertising business in North America, I think, is going to pick up in Q2 through Q4. We also typically see some seasonality, some softness in Q1. But as you head into the sports season, we do anticipate both revenue and CPM to increase there. On the international front, I think we're still in the very, very early days. As I'm sure you know, we've acquired a company in France that also exceeded expectations with 305,000 paying subscribers. And that business is, again, in its early days, and we're in the process of unifying our technology platform. We believe there's about $75 million of savings over the next 3 years, or cost synergies that we'll be able to experience. So, we're in the business of building a live TV streaming platform. And there's over 1 billion pay TV customers globally. So I think the opportunity is immense.
And I want to talk Fubo Sportsbook because it was named the authorized gaming operator of NASCAR last year. Talk about sports betting as we see it's continuing to heat up. How do you see Fubo playing a role in that, as well as competing in the space with some of the other big names?
Yeah, very good question. I think in terms of competition, we have certainly proven ourselves as a competitor. We launched our Vert video service about 1.5 years after companies like DirecTV and Sling, and where we had 1/100th of their sub counts, and today we're closing in on 45 to 50% of their sub bases when they have market caps of 20 million plus. So I think in the gaming space it's very similar. We take a very measured and disciplined approach. We're continuing to develop technology that allows us to differentiate our product. In my opinion, we're not competing directly with the sports books, but we're creating an interactive experience that allows passive viewers to become active participants. And the feature sets that we're building allow this type of interaction that currently is not available anywhere. The last thing I'll say is that our goal is to really take advantage of our growing subscriber base and leveraging that subscriber base to drive consumers that love sports into the sportsbook with really minimal cost to us. So that's sort of the game plan, and we feel that we're well positioned to take advantage of all of these macro trends.
And so then as we look at the long-term view then, what are your plans in terms of partnerships and ways to grow? We did see the JP Morgan analyst Philip Cusick cut his rating for Fubo to underweight due to concerns about the long-term business model. What are you keeping an eye on long-term?
Yeah, look, long-term, obviously I disagree. I think it's become very clear. If you look at the last couple of surveys that have been put out by Accenture or even Nielsen, where 64% of people are actually very unhappy with the streaming landscape. It's very difficult to discover content. It's difficult to find things that you're looking for. And you really can't leverage any of the new technology, the personalization that's coming out, forcing you to move from app to app, which is quite difficult. So in my opinion, I think that people want efficiency. They want an effective viewing experience. And as I like to say, that 1 million people have voted for Fubo with their wallets. And we're continuing to take market share from our competitors. And we think that this is aggregation and bundling is the future of television.
And certainly, speaking of wallets, you ended the quarter with 456 million in cash. Talk about your plans for that money.
Yeah, so I think what you're seeing in our guidance and in our overall tone is that we're trying to strike a very appropriate balance between subscriber growth and operating leverage. And this, a fortified balance sheet gives us the flexibility to achieve our path to profitability. Our goal is to achieve cash flow, or positive cash flow in 2025. And again, this is that those funds allow us to do that, particularly in a market right now that is extremely volatile.
And just lastly, I noticed that on Twitter, you regularly field questions from people about earnings, about what the company is doing. How important is that engagement to you?
Well, it's very important to me. I'm pretty sure it's important to a lot of the retail shareholders that don't get access to CEOs. But we run a very transparent operation here. The folks at Fubo, from the management team all the way down, are working hard to deliver results. We went public 2 years ago into a pandemic with about 250 or 260,000 paying subscribers. And this year we're targeting over $1 billion of revenue, excuse me, and 1.5 million, roughly 1.5 million subscribers. So, my job is to make sure that people understand what we're doing, how we're doing it. And, I take every retail investor question very seriously.
I know they appreciate that. I can tell by the responses online. Thank you so much. David Gander there, Fubo TV's co-founder and CEO. Thank you for your time this afternoon.
DraftKings reporting strong earnings for its first quarter of 2022. Revenue jumping 34% to $417 million. The online sports betting company also raising its guidance for the year. Here to discuss this is DraftKings CEO Jason Robins. Jason, it's great to see you again. Congratulations on the strong quarter. Taking a look at some of these other numbers too. Monthly unique players growing to 2 million. Average revenue per monthly unique payer growing to $67, beating the street's estimate. What's driving this increase that we're seeing in your business?
I think it's just really, very strong cohort performance along with a real influx of new customers. And, this is the phase of the market we're in. New states are opening up. we're seeing more and more customers come into the market. And we also feel like with the strides we've made over the last couple of years on the product and technology side, we have a product that's even better than it was a year or two ago at retaining and monetizing customers. So I think all that's coming together and really leading to growth across all of our KPIs.
Jason, speaking of bringing in new users, you just completed your acquisition of Golden Nugget's online gaming business, a $1.5 billion deal for you. Talk to us just about the opportunity here and what this deal means for your audience reach.
Yeah, and just to clarify, at the time we announced it was $1.5 billion, but it was not a fixed price deal. It was a share-based deal. It was 100% stock. So I think it was about 29 million shares. So, I think that's just one thing to clarify. As far as what the deal means for the business, one, we're really excited about the team that's coming on board. Thomas, Warren, the whole team is great and really knows the iGaming business well. Tillman Fertitta is obviously a great addition to the shareholder register. He's been very helpful in terms of advice, and obviously he knows how to create value, and having him on the team is going to be helpful too. And then from a strategic standpoint, it really fills an important need we had. While DraftKings has been a very strong sports brand, we've actually done very well in iGaming with customers that we acquire on sports and cross-sell. We've only done okay relative to our expectations in penetrating the non-sports fan casino-first audience. So when we looked at Golden Nugget's demographics, when we looked at their data, it was very clear that they do extraordinarily well with that segment. So their brand will be very complementary to ours. And additionally, it should be great from a financial standpoint. We're going to see about $300 million of synergies long-term once we've realized all the integration plans and everything is sort of coming to line. So really just, checked a number of boxes up and down the board.
Jason, one thing that you mentioned in your earnings call this morning got investors' attention were your plans to enter Ontario, something that investors would likely be very excited about. What's the timeline of this?
Right now we're working with the regulators to get licensed and receive regulatory approvals. So, it's something that we're hopeful is soon, but we're not in a position, given it's not entirely within our control, to put an exact date on it at this point.
Well, speaking of expansion plans, we know California, very important not only to your company, but for the broader gaming business as well. Are you confident that there will be something on the ballot come the fall, and also that we will likely see legalization in the state?
Definitely feel very confident there'll be something on the ballot in the fall. We believe that we've reached the number of signatures required once validated, which, formally has not happened yet, but we believe we are there. So we feel very good about being on the ballot in the fall. As far as will it pass right now, we're seeing great polling numbers. There seems to be a lot of enthusiasm. The bill's, set to generate hundreds of millions of dollars of tax revenue per year per third parties. And also, that revenue will be directed towards very important things that California needs, revenue assistance with, like homelessness and mental health. So, really feels like it's a great bill for California. And our hope is that the voters recognize that and choose to vote for it in the fall.
Jason, what about inflation? Are you seeing any impact from inflation on users' betting habits?
No. In fact, one of the things that, I've been surprised is that a lot of people don't realize that this isn't just something we're seeing now, which we are. We're seeing absolutely zero impact to our customer cohorts due to any sort of inflationary pressures or otherwise any other macroeconomic factors. Not only are we seeing that, that's historically always been the case with gaming. Gaming has generally been very well performing during economic downturns, recessions, inflationary periods, and the like. So this is not a new thing. This is something that's been well known about the industry for quite some time, and we're certainly seeing the same thing materialize in our numbers. And I think as a result, once people sort of do the research and figure that out, I think we're going to be seen as an attractive stock to own in an inflationary period. I think right now, though, people are less focused on that and more focused on Fed response and what that means, for growth equity and equity in general. But I think once the market's kind of digested all that and people start looking at what stocks do I think and what companies do I think will perform well during inflationary periods, I believe that we will be on that list because, facts support and our data supports that we're going to do very well during an economic period of inflation or a recession.
Well, Jason, you had strong numbers for the latest quarter, yet the stock reacting negatively today, obviously losing some ground with the broader market. But you've called out some of those sellers in the past. You took to Twitter a couple of months ago saying that you want to make sure that they regret this decision to sell the stock more than any other decision they've ever made in their entire life. What are they getting wrong? What are they missing?
Well, I mean, that's all I said. If you read it, is that we're working to do that. I'll let others decide whether they think that, they made a mistake or not. And over the long term, I think we'll see. But certainly that is what every day we come and do. And I have never seen a team more motivated, more focused than I see ours now. So I like our chances. But, in the end, we have to prove it. And I get that. And, talk is cheap. So I put that out there. But, now we're in full execution mode. And I'm not going to say anything else until we've proven it.
All right, Jason Robbins, CEO of DraftKings. Always great to have you. Thanks so much for taking the time.
In this episode of Influencers, Gregory Zuckerman, author of A Shot to Save the World.
Well, I think we're too close to this miraculous development of these vaccines to appreciate the enormity of it. I really do think it's modern science's greatest achievement. I believe that this pandemic is going to end, but this virus is not going away. It's going to be endemic. It's going to kind of melt into the background, but we're always going to have things cropping up. I write the same story all over again, over and over. I write about overlooked, underappreciated individuals achieving something that the experts told them they couldn't do.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Gregory Zuckerman, award-winning journalist, special writer at the Wall Street Journal, and author of the new book, A Shot to Save the World, the inside story of the life or death race for a COVID-19 vaccine. Greg, nice to see you.
Great to see you, Andy.
So congratulations on the book. A lot to talk about. You've noted that you wanted to focus on the triumphs, I guess I should say, of the development of the vaccine. And one thing you talked about was a lucky break that occurred with regard to mRNA research, which occurred a couple years before the pandemic, which probably allowed for the rapid development of the vaccine. What would the world look like if the pandemic had arrived 5 years earlier? Do you think we'd still be waiting for a vaccine?
It's a great question. So I think we're too close to this miraculous development of these vaccines to appreciate the enormity of it. I really do think it's modern science's greatest achievement. And to your point, the technology was not ready a few years ago. So we need to be grateful that the pandemic, that this virus emerged at a time when the scientists I write about in my book thought they had an approach that would work. They weren't sure. We're talking the end of 2019, very early part of 2020, and they turned around, they created these really effective protective vaccines. But again, a few years earlier, I don't think we would have been nearly as lucky.
But there's a few different types of science that have been applied to the different vaccines. Do you want to just go through them and sort of layperson's term, which I know is your specialty?
Sure. So mRNA, we are familiar with that approach, that vaccine approach, because that created the Moderna as well as the Pfizer vaccines. mRNA is short for messenger RNA, which is just a molecule we have inside of us. It transports instructions from the DNA to the part of the cell where proteins are created that we live on and we depend on every day. And it was always this sort of dream of scientists to create mRNA in the lab. Well, if it's so important in the body, maybe we could create a synthetic version, just like there's, sugar, natural sugar, and synthetic version of sugar. So the idea was, well, if we could create mRNA in the lab, we could tell our bodies to create any protein. And that was the idea. That's the gist of the mRNA approach. It's a vaccine. It sends a message. And the message, obviously, in this case, is an instruction for the body, the immune system, to create the protein. The protein in this case is the spike protein. So like any other vaccine, it's an education for the body. And the other approach I write about, the adenovirus approach, that led to the J&J as well as the AstraZeneca vaccines. That's a really interesting one too. That one also took years in making. And I write about how that began really with the HIV effort to solve HIV. We haven't figured that one out yet, but they shifted, these scientists, and said, okay, we can't do HIV, but we're going to get a vaccine for COVID.
Yeah, Dan Baroque, one of the scientists working on that later endeavor I spoke to, has been, and you're right, been working on that for a very long time. But switching back to mRNA, you do focus a lot on Moderna, which could have been one of the biggest losers in the race for the vaccine, ended up being a big winner. How much credit should the Moderna CEO get here? It sounds like his background as a salesman was sort of key in bringing this all together.
Yeah, he's a fascinating character. For years, people whispered about him. They suspected he was exaggerating Moderna's ability to create either vaccines or drugs. There wasn't much proof. They were a very secretive kind of firm. He was very hard on his employees. You can read about it in the book. People were collapsing in the office, outside the office, at home, hitting their heads, being rushed to the emergency rooms. He was firing people left and right. Very difficult, and yet inspirational too, and hard driving. And he had a vision. His vision was that mRNA was going to save lives, and he felt he needed to push his people hard. He's a little bit of a Steve Jobs kind of character in that regard. And he said, guys, one day we're going to be the ones to step up in a crisis. And he was right. And maybe it takes somebody like that. And like you said, he's a great salesman, and he raised billions and billions for Moderna over the years without any proof of concept. And people were jealous. There were a lot of envy in the industry, but turns out that money was well spent, and people made a lot of money investing in Moderna.
Yeah, and I heard, whispers in Boston in that biotech community about him for a while, just what you're sort of saying, Greg. And even while they were sort of getting up to speed, that, maybe charlatan is too strong a word, but they were serious doubters. Do you think those people, are sort of eating crow right now?
So, Andy, in my book, people compared him to Elizabeth Holmes. They said, just like Theranos, there's nothing there to this company, Moderna. And, you can understand it to some extent. They didn't have any proof. They had spent years working on drugs, and I write in the book, they gave up on making mRNA work for drug. They had to pivot to vaccines because it wasn't working with drugs, and vaccines is not a really popular area for a lot of pharmaceutical companies. So are they eating crow? Yes. But, there is some reason why they were skeptical all those years, but in the end, they were wrong.
Right. Operation Warp Speed. Where do you come out on that? I mean, this was a Trump administration program, controversial. There were some, let's just say, colorful people steering it. But was it effective, Greg?
So, like most every other topic in society today, it's sort of black and white, me against you. Either Operation Warp Speed saves everything and we have to give Donald Trump all the credit, or it was useless. I come down somewhere in the middle, meaning that Operation Warp Speed was very helpful. There's a lot of money that was given to these companies, resources too, little parts that were necessary from all over the country that were brought to the necessary spots by Operation Warp Speed employees. But you also have to remember that Warp Speed made an early bet on a different vaccine, the AstraZeneca vaccine. It did not give money to Moderna early on when it was desperate for money. And Moderna, as recently as May 2020, was running out of money and couldn't get money from the government, couldn't get money from private industry, from public, from foundations, from Merck. They went to Merck. And they were almost unable to create these vaccines. One more reason to be grateful for what happened. So Operation Warp Speed was very helpful. In the end, Moderna did get a lot of money from Operation Warp Speed. Others did too. But you don't want to say it was all due to Warp Speed, the success of these remarkable vaccines.
There is the prospective case where the government's going to suggest that every person in America gets a booster, Pfizer booster as well, right?
Or Moderna. And I
Moderna,
think
right.
that is coming, right. And also just sort of down the road, I believe that this pandemic is going to end, but this virus is not going away. It's going to be endemic. It's going to kind of melt into the background, but we're always going to have things cropping up, areas that aren't vaccinating. We're going to have issues. It's going to morph, and we got more strains. I'm not saying this for people to be too concerned. I do think Pfizer, Moderna, and the other companies can adjust their vaccines. So you'll go in and there'll be second and third generation vaccines. You'll go into a doctor's office and get a COVID vaccine, but it'll be an all-in-one, maybe with a flu vaccine. Maybe they'll throw something else in there too. So I don't want people to be too discouraged, but the vaccine researchers that I write about, they're trying to stay ahead of this thing.
Yeah, I mean, is that a losing battle? Is it going to be like the flu? We're going to continue to need new vaccines all the time? I mean, this seems like it's not going to just end as you suggest.
Yeah, it won't.
Right.
It won't. But I wouldn't call it a losing battle. I think we'll stay ahead of it. And these vaccines are so much more effective than the flu vaccine. So if you've got protection of 70, 80%, and it's even higher for hospitalization and death, it will allow us to return to to a normalcy, really, in society.
You hear that other countries' vaccines are not as effective, like the Chinese vaccine. I don't know where the Russian vaccine stands. I heard there was one in Cuba that was not effective at all. Like, why is that?
Well, they use different approaches. So I write in the book a little bit on the Russian approach is a variation on the one that you mentioned with Dan Baruch and the J&J one. It's not quite as good. And frankly, we just don't have as much data that's reliable. It doesn't help that Putin himself didn't take the vaccine for months and months. He wouldn't take it. So listen, if that was the only vaccine in the world, either the Russian one or the Chinese one, I think we would all embrace it and take it. It's largely effective, but it's just not as effective. mRNA, as revolutionary as it is so much better than these other vaccines.
How come Merck and Sanofi and other companies that are known as leaders in this space were not at the fore?
That's a great question. And frankly, when I started researching this book, I kind of expected the vaccine giants to be the ones to save us. I mean, Merck is the one that created the MMR vaccine that we're all familiar with, the mumps, measles, rubella. They're a vaccine giant. So is Sanofi, as you say, and GSK. And yet they sort of drag their feet. I write about some internal rift within Merck about whether to pursue a vaccine for COVID-19 or not. GSK and Sanofi teamed up, but their approach isn't quite there yet. I would argue that vaccines, until this past year, are not a really sexy area for big pharmaceutical companies. You get one every few years, or once a year, once a lifetime maybe. It's just so much you can charge for a vaccine, and as a result, I think the big pharmaceutical companies had mixed feelings about chasing after a vaccine for COVID-19.
There's no money there?
There is, as we're seeing that this past year, but at the time it wasn't clear. And listen, you put all this work into it, and they've done this. Merck has chased vaccines in the past for things like Zika and such that have dissipated, have gone away, and they wasted tons of money, resources, et cetera. Opportunity cost was high. So if you're going to chase after a vaccine, and when you don't even know if there's going to be a need for it by the time you develop it, it's a risky business proposition.
Right. Moderna just recently announced an agreement with Gavi, which is the Vaccine Alliance, to ship more vaccine doses to areas around the world that are still behind in 2022. Is this too little too late?
I think it's popular to criticize Moderna. You see how much money they're making. There were always these suspicions about them. I think in the back of people's minds, they remember those questions, and they're eager to criticize Moderna. I'm not here necessarily to defend them, but I do have to note that they didn't have a partner. Unlike BioNTech, which worked with Pfizer, Moderna couldn't find a partner. Merck turned them down. So they had to do it all themselves. And they've been taxed. They've been going to the limit. I know the people internally, they believe that they wish they had been able to produce more, but their vaccine supplies were scooped up by the West. They paid the most and they got there early. And now they're trying to help elsewhere. Is it too little too late? I would say it's slow and happening, but I also understand what's going on internally within Moderna. They're just destroyed physically, psychologically. It's been a really difficult year, even though they've made a lot of money.
By the way, you just solved a little mystery in my brain, Greg. BioNTech, that's how you pronounce it?
There are different ways of pronouncing it. Even internally, they pronounce it differently. But yes, that's why I pronounce it BioNTech. You can't go wrong that way.
It's like Tesla and Tesla. We asked the people there how to pronounce it. They said either.
Really? That's funny. I didn't know that.
What about mRNA research? Where do you think the next breakthrough is going to come from there, and how will this change the development of future vaccines?
So there's a lot of excitement now about what mRNA can do besides COVID-19. Ugur Sahin and BioNTech have been working on cancer vaccines for many years. They're very excited to take the billions they're making right now and shift and focus on other pathogens, ailments. And so is Moderna. So we're talking about everything from lupus and MS, turning off the immune system, just like we've been able to turn on the immune system, perhaps for autoimmune kind of issues. Malaria, some people are going after. Dan Baruch, as you mentioned, AIDS. So some of these same vaccine specialists, revolutionary, pioneering researchers that I write about in my book are shifting to all kinds of new challenges. Now, I want to caution just a little bit because until this past year, mRNA has proved pretty disappointing when it comes to drugs. And there are some vaccines coming up, I believe, for things like RSV and CMV, some viruses that are very lethal and harmful for some people. But I want to have a little bit of caution in terms of revolutionizing the world, but I'm excited about the future.
I want to ask you about vaccine hesitancy. As someone who intricately knows how these vaccines came to be, what do you make of these continued conspiracy theories around them, and how much are they hurting efforts to get everyone vaccinated?
So, Andy, I speak to a lot of vaccine hesitant audiences, and I enjoy doing so. There's always a split. There are some people who are reasonable and cautious, and for good reasons. They're wary. I get it. These vaccines were developed in 330 days from the time the sequence was revealed until they were authorized, and historically, that's just remarkable. I mean, the average vaccine took 10 years until last year, and the fastest was 4 years. So here we are coming in 330 days. So I understand the wariness, and mRNA has never been proved effective. That said, one of the reasons I wrote my book is to show that it was years of research. It wasn't done quickly. They didn't cut corners in any way. What we've been able to do, and partly thanks to Warp Speed, was we were doing things simultaneously. We were developing, testing, and manufacturing a vaccine. That's never been done before. Why would you spend billions of dollars to manufacture a vaccine if it's not even authorized or approved yet? No one ever did it historically. So those are the kind of reasons why I think some people were hesitant, and I think they should be reassured by the fact that there were corners cut. And this process, this research, these vaccine approaches took years. And that's partly why I wrote the book. Now, in terms of conspiracy people, conspiracists, you're not going to make much headway there, sadly.
You've been skeptical, my understanding, Greg, of that you've been skeptical of the so-called lab leak theory when it comes to Wuhan and China and the origins of COVID-19, the idea that it came from the Wuhan lab. But the pandemic's origin has been really difficult to pin down definitively. How much have you focused on that question in your reporting, and do you think we'll ever have a clear answer there?
So I am skeptical of the lab leak. I'm even more skeptical that China created this vaccine. And my reporting is based on talking to top virologists, structural biologists, et cetera, around the world. And the view is that it's a little bit like HIV. HIV, for years, there were suspicion about that as well. People accused the CIA, the US government, the US Army, the KGB of creating this virus because there was no natural host. There was no evidence of the animal that had the original virus. And then they found one. It took years, about a decade or so. And likewise, we haven't found the host here, but I think it will be identified. It takes a little bit of time. Those people who say it was created by China, and then they said, well, it won't spread in China, we'll only make it spread elsewhere. That seems preposterous. And the lab leak is a possibility. I'd say it's a 5 or a 10% possibility. But if you just remember that animals, we're encroaching on wild kingdom all the time, cutting down trees. Viruses are jumping all the time from animals. We saw it with SARS. We saw it with the earlier coronaviruses, MERS, others. So to expect this one to be unusual and surprising and to have been leaked, it's possible, but unlikely. I'm an Occam's razor kind of guy.
Right. Is the wet market, does that come into play, you think, or is that kind of a blind alley?
No, I think there's a good possibility that it spread there. I'm not sure it originated there necessarily, but historically, that's how the first one spread too. The first SARS in China in a wet market. There's a good chance that that's how it spread.
Right. In recent weeks, well, we talked about the pill a little bit. I just one last follow-up question on that. And so, is that a big breakthrough or not?
I think it is. I think it's going to be a kind of a 1-2 punch that's really going to help us get out of this pandemic as long as people continue to get vaccinated. But we've got this backup of pills that are quite effective. I think modern science is going to be fixing this thing and addressing this thing and helping us out of this pandemic. Yeah.
What do you make of Tony Fauci? I mean, is he this American hero, or, listen, we're both journalists. We're like, it's not all that. Or is he all that, Greg? What do you think?
I think Tony Fauci is a hero. His whole life is dedicated to public health. It's a remarkable and quite frankly, just depressing idea that we as a people or part of our country have turned on those who look out for us. Is he perfect? No. He advised us early on not to wear masks. He couldn't have been more wrong about that. There were all kinds of mistakes he and other scientists have made. But for Tony Fauci and his colleagues at the NIH, others, they could have quit years ago and made a fortune in private industry. And they didn't. Why? Because they look out for our health and they're trying to give us good advice and